Let's go on the record. Good morning, everyone. Today is Friday. This is day 5 of the Spire General Rate Case hearing, which is captioned GR-2021-0108. The parties have filed a total of 3 non-unanimous stipulations and agreements, and those have addressed all remaining issues in the case, thus leaving only our cost of capital issue for today. We will have 4 witnesses, and before we get started, we will have many opening statements. And let's go ahead and invite Spire up to the podium. Thank you.
Your Honor, I apologize to interrupt. I just had a really quick request on the issue of cash working capital, and this is Kurt Stokes for the staff, by the way. I apologize. Because the hearing officers requested exhibits for some IRS private letter rulings, I don't know if I'm going to use them yet. I did some late night research. I'm still looking at it, but if we do use them, with the commission's leave, I'd like to admit 3 exhibits. I think they're staff exhibits 141, 142, and 143, I believe.
Okay, tell me what those are.
Okay, the first one, exhibit 141, and I'll pass these out. The first is IRS private letter ruling 2015-41010. Exhibit 142 would be the final order in Virginia State Corporation Commission case number PUE-2013-00061. And exhibit 143 would be the report of the senior hearing examiner and Virginia State Corporation Commission case number PUE-2013-00061.
Tell me where we're at. Are you offering these for admission now?
Yes, just as exhibits. And again, I don't know if they're going to be in staff brief or not. We need to take a closer look, but if we do, I wanted to make sure that they were in the record.
No objection from Spire, Your Honor.
The OPC does not anticipate making an objection, but would like the opportunity to review the document. Is it admissible that we might be able to, if necessary, file written objections sometime early next week, if necessary?
Yeah, that seems fair. I will figure out a date later on in the hearing. I'm going to write a note, but let's try and remember that.
Thank you, Judge, and I apologize for the interruption.
No, not a problem. It seems as the parties have already discussed it. I am curious as to what these are. I do not recall these cases off the top of my head. The Virginia cases I'm a little fuzzy on.
Oh, they're brand new.
Oh, okay. I'm sorry, enough humor. I don't want to take up time. We have our objections set. No objections on the admission of exhibits 141, 142, and 143, so admitted. Mr. Carroll.
Thank you, Your Honor, and good morning. My name is Frank Carroll. I'm outside counsel on behalf of Spire, Inc., and may it please the Commission. We're here this morning to talk about cost of capital. We've particular return on equity in the capital structure. Commission must set a rate of return, a return on equity in this case, that is commensurate with the returns on investments in other enterprises having corresponding risks. That's the standard. The return must be sufficient to assure confidence in the financial integrity of Spire so as to maintain credit and to attract capital. These are the standards set forth in the often cited open Bluefield cases, the Supreme Court cases. Spire's expert witness, Dylan DeSantis, will be on the stand soon, conducted the most robust analysis of the ROE necessary to meet these standards. Mr. DeSantis conducted a capital asset pricing model known as CAPM, a discounted cash flow analysis, DCF, and a risk premium model known as RPM, applied to both a utility proxy group. For further confirmation of his results, he applied the models to a non-utility proxy group as well. The result of his analysis is a recommended ROE of 9.95. Conversely, the recommendation of 9.25 and 9.37 of OPC and staff, respectively, are not sufficient to meet the Hope and Bluefield standards. We intend to show that if just a few endpoint changes are made to staff's models, staff's recommendation actually goes from 9.37 to 9.99%. A 9.99% ROE is more in line with the upward trending ROEs for gas utilities throughout the country. Further, the latest figures from RRA, the Regulatory Research Association, published by S&P Global Market Intelligence, which publishes ROE results throughout the utility sector, indicate that the average ROE for gas utilities in the first half of 2021 is 9.62, up 16 basis points from the average in 2020. Now let's turn to capital structure. OPC also takes, first let me explain, staff and the company are in agreement with the capital structure. OPC also takes issue with the Commission's finding in Spire, Missouri's 2017 rate case with regard to the capital structure used to set overall rate of return. In 2017, the Commission found that Spire, Missouri's own capital structure should be used to set the rate of return. OPC takes the extreme position that Spire Inc.'s capital structure should be used even though Spire, Missouri is financially independent from its parent. As was the case in 2017, Spire, Missouri issues its own debt, which supports its own bond rating. Spire, Missouri's assets do not guarantee the debt of Spire Inc., its other utilities, or its unregulated operations. Spire Inc. holds 5 utilities in 3 different states, a FERC-regulated interstate pipeline, and other businesses not under regulation by this Commission. These are the same facts today that led the Commission, these are the same facts today that lead the Commission to use Spire, Missouri's own capital structure in 2017. Staff agrees that this is the correct approach. OPC's approach is extreme and would destabilize Spire, Missouri's credit rating, increase the cost of equity, increase the cost of debt, and reduce Spire, Missouri's access to short-term financing. The end result of OPC's approach would be to increase the cost to Spire's customers. For these reasons, the Commission should be consistent and use Spire, Missouri's actual capital structure as used in the 2017 case and as recommended by both staff and the company. Using Spire, Missouri's actual capital structure into 9.95 ROE results in an overall allowed return of 7.23%. Thank you.
Thank you, Mr. Carey. No questions?
May it please the commission. My name is Kevin Thompson and I represent the staff. We are here today to take up the issue of cost of capital, which is generally one of the largest issues in terms of its value in a general rate case. As you will recall, cost of capital is all about calculating the rate of return by which the rate base is multiplied in order to calculate the return on investment that is part of the revenue requirement. This rate case is unusual. Staff is aligned with the company on capital structure, the cost of long-term debt, and the exclusion of short-term debt. However, staff is aligned with the Office of the Public Counsel on the issue of return on equity, generally referred to as ROE. With respect to ROE, staff's expert financial analyst, Dr. Sung-Jun Won, recommends an ROE of 9.37% within a range of 9.12% to 9.62%. David Murray, the OPC expert, recommends an ROE of 9.25% within a range of 8.5% to 9.5%. Because OPC's recommendation is within the range recommended by Dr. Won, staff is essentially aligned with OPC on the issue of ROE. Spire's experts, on the other hand, recommend an ROE of 9.95 within a range of 9.94 to 12.07%. That recommendation is outside of Dr. Won's range and is frankly too high. Dr. Won will testify that Spire's experts obtained their overly high recommendation by using unreasonably high inputs in their calculations. In their discounted cash flow model, in which a dividend factor is added to a growth rate to obtain a result, Spire's experts used inappropriately high growth rates. Spire used an average short-term analyst's growth rate of 6.16%, in excess of the projected long-term GDP growth rate of 3.8%. It is well understood in the financial services industry that a firm cannot grow faster than the economy in perpetuity. In the risk premium model, in which an equity risk premium is added to a risk-free rate to obtain a result, Spire's experts use two different equity risk premiums, both inappropriately high. And in the capital asset pricing model, in which a market risk premium is added to a risk-free rate and then multiplied by beta to obtain a result, Spire's experts used an inappropriately high market risk premium of 10.5%, compared to the financial services industry's standard estimates between 4% and 7%. The same critical weakness is found in Spire's empirical CAPM. Spire's experts also used an inappropriate non-regulated proxy group consisting of 41 unregulated companies. Mr. DeSantis contends that because his gas utility proxy group and his non-price regulated proxy group share similar betas, that they have the same business risk and thus are comparable. Beta is the volatility of a security compared to the volatility of the market as a whole. The truth is that beta alone cannot explain all business risks. Staff found that earnings per share growth rates and equity risk premiums for the non-price regulated companies are significantly higher than those figures for the price regulated natural gas utilities by 348 basis points and 193 basis points, respectively. This demonstrates that the non-price regulated companies and the price regulated natural gas utilities are not reasonably comparable for purposes of estimating the cost of equity. These purportedly comparable companies, in fact, are not comparable at all, and their use leads to an inappropriate, upwardly biased result. Spire also applied unnecessary and unsupported adjustments to raise its recommendation by another 20 basis points. These adjustments for size and flotation costs. Spire Missouri is smaller than the average of Spire's gas proxy group. However, Spire Missouri's long-term issuer rating from Moody's is greater than the average long-term issuer ratings for Spire's gas utility proxy group. It is understood in the financial services industry that a higher bond rating brings a lower risk premium. Spire's size adjustment is thus unnecessary because the bond rating agency has already considered overall financial and business risks when the higher rating was determined. Spire has also improperly attributed Spire Inc.'s flotation costs to Spire, Missouri. Those flotation costs are entirely unreasonable and inappropriate and should be rejected. For all of these reasons, Spire's ROE recommendation should be discarded because it is the result of inputs and calculations that are inappropriate. In the area of capital structure, Dr. Wan recommends the use of Spire, Missouri's own capital structure, consisting of 54.28% equity and 45.72% long-term debt. This is the same capital structure recommended by Spire's experts. OPC, on the other hand, recommends the use of the capital structure of Spire, Missouri's corporate parent, Spire Inc., consisting of 45.37% equity, 45.35% long-term debt, and 7.28% short-term debt. OPC's recommendation is entirely inappropriate, as Dr. Wan will testify. There are situations in which staff believes the use of the parent's capital structure is appropriate for rate making, but this is not one of them. There are 4 factors to consider in determining whether to use the parent's capital structure. 1, whether the subsidiary utility obtains all of its capital from the parent or issues its own debt and preferred stock. 2, whether the parent guarantees any of the securities issued by the subsidiary. 3, whether the subsidiary's capital structure is independent of the parent. 4, whether the parent is diversified into non-utility operations. None of these 4 factors supports OPC's position that the parent's capital structure should be used. Spire, Missouri raises its own debt capital, so its own capital structure is the one that should be used. Mr. Murray will tell you that Spire Inc. has managed the capital structure of Spire, Missouri in order to reflect the ratio approved by the Commission in Spire, Missouri's last rate case. That is no reason to penalize Spire, Missouri. By doing so, the company has simply complied with the Commission's most recent rate-making order. It is staff's position that Spire, Missouri's Commission-approved capital structure is entirely just and reasonable. Staff does not agree with OPC that Spire Inc., the parent company of Spire, Missouri, manages Spire, Missouri for purposes of taking advantage of the debt capacity afforded by the low-risk regulated utility subsidiaries. Staff notes that Spire, Missouri's capital structure is consistent with the capital structure ratios maintained by or authorized for other natural gas utilities, while OPC's recommended common equity ratio of 47.36% is much lower than the average of its natural gas proxy group's common equity ratio of approximately 51%. The parties agree that Spire, Missouri's cost of long-term debt is 3.99%. Staff and the company do not agree with OPC's recommendation that short-term debt be included in the capital structure. The Commission does not include short-term debt in the rate-making capital structure in general. Staff would only recommend its inclusion in certain circumstances which do not apply here. In conclusion, I urge you to adopt the thoughtful and well-supported recommendations of staff's expert financial analyst, Dr. Sung-Jun Wan. Staff urges you to reject the bloated ROE recommendation offered by the company's experts, including the several unnecessary adjustments proposed by Spire. Staff urges you to reject the capital structure recommendation offered by OPC, which is intended to significantly reduce the revenue requirement. And finally, staff urges you to exclude short-term debt from the rate-making capital structure. Thank you for your attention. I will be happy to attempt to answer any questions.
Thank you. No questions.
Thank you.
And Mr. Kleiser, as you make your way to the podium, I can inform you that I have forwarded your PowerPoint onto the commissioners so that they can follow along. And we'll be leaving the WebEx camera facing you at the podium, while those in the hearing room can follow along on the large witness stand TV.
Thank you, Your Honor.
As you're ready.
One moment, please. If it would please the commission, John Kleiser, on behalf of the Missouri Office of Public Counsel. So, we're here to talk about rate of return. We've already heard there are several items we need to discuss: capital structure, return on common equity, or ROE, cost of long-term debt, and the cost of short-term debt. Now, as far as the cost of long-term debt, there really isn't any dispute among the parties. It's only a slight difference based on timing, and I'm not going to cover that in this opening. It's fairly simple. As far as the cost of short-term debt goes, as you've already heard, the OPC is the only one arguing for the inclusion of short-term debt, so we're the only parties who have put forward it. And we are asking to use Fire Missouri's actual cost of short-term debt, which is 0.2%. And I want to stress that's not a mistake. It's 0.2%. Incredibly low, which is one of the major reasons that, well, it's one of the main factors in why short-term debt needs to be included. I'll get to that, though, at the end of the slide. Let's start with capital structure. So there are two important considerations when thinking about capital structure that I would like for the commission to remember. The first is that debt capacity is directly tied to business risk. A riskier business should have less debt. A safer business has a larger debt capacity. And of course, you can think about this just in terms of asking yourself, who's going to have the easier time getting a loan from the bank? Risky business, the safe business. Safer business is going to have an easier time getting a loan. They're going to have to put up less money up front. It's no different than if you are going to go buy a house. The more money you can put up, the easier your loan is, the cheaper your loan is. We've all done this. We know this. Less risk means more debt capacity. The other major consideration is that for competitive businesses, non-regulated businesses, which again is what the commission is hoping utilities will emulate, there's the goal to balance two competing interests. On the one hand, you want to get the lowest cost capital you can, while on the other, you want to maintain a reasonable sound credit quality. This is the goal of actual competitive businesses, to balance these two competing interests. So let's take a look at how Fire Missouri's capital structure stacks up to its parent, Fire Inc. I apologize, I know that the numbers here are very small, but the first thing I would draw your attention to is that Fire Inc., for both a 3-year and 5-year average, has been carrying less equity and more debt than its own subsidiary, Fire Missouri. Now that should be a big red flag. Why? Because Fire Missouri is by far a less risky and safer business than its own parent. And you can tell the reason for this. In fact, it's one of the very reasons that the staff council got up and explained, you know, why you needed to give Spire, why you shouldn't use a consolidated debt. They said, hey, look,
I'm sorry, why you,
shouldn't use a consolidated debt. They said, hey, look, Spire Inc. has all these other subsidiaries attached to it, regulated and non-regulated. It does. That makes it more risky. That means it should, in theory, have more equity and less debt. But it has more debt, and we'll get to why on the next slide. The other thing I really want to point out is that, again, on both a 3-year and 5-year average, both Spire Inc. and Spire Missouri are carrying about 10% short-term debt. That means 10% of their capital structure is made up of short-term debt. We're going to revisit that when we get to the short-term debt issue. The last thing I want to point out here, and this isn't on this slide, when Spire made a request for a capital structure to FERC for the STL pipeline, they requested a 50-50 capital structure. Again, Spire is continuously maintaining that other riskier subsidiaries should have less equity and more debt than its safe, secure Spire, Missouri business, which makes no sense. So why? Why does Spire Inc. have more debt? The answer is that Spire Inc. is actively managing its capital structure. They are doing what you would expect a competitive business to do, trying to achieve the most cost-effective capital. Moreover, Spire Inc. gets a benefit from Spire, Missouri having so much more debt equity. Why? Because Spire, Missouri having a lot of equity creates a lot of cash flow that flows up to the parent, Spire Inc. And then Spire Inc. uses all that cash flow to financially support its unregulated operations by making parental guarantees for debt instruments that are given out to other non-regulated entities. So you see, Spire, Missouri is subsidizing Spire Inc. and all the non-regulated activities by maintaining a purposely high equity ratio. And it's doing this to ensure that this happens. Spire, Missouri is purposely targeting and maintaining the highest equity ratio it can achieve based on the Commission's order. Now, I want to make it very clear. When I say they're targeting, there is absolutely no question about this. And to point that out, I'm going to talk briefly about Staff GR-2021-0108. Now, you're looking at this and you're saying, I can't read this. That's fine. I'm going to blow up the important parts. Effectively, staff asked for a copy of all the materials and documents that would show how Spire Inc. or Spire, Missouri manages its capital structure. And what was Spire, Missouri's response? They don't have anything. They're managing it exactly so that they get right at what the Commission ordered. And again, they're getting to what the Commission ordered in order to maintain the highest equity possible so they can flow as much cash to their parent who can use the money to send out to the other subsidiaries. What are the effects of this? Well, the biggest and most troubling effect, in my opinion, is that the Commission has now become the de facto manager of Spire's capital structure. You know, the Commission often says, we don't want to make business decisions on behalf of the company. You are now making a business decision on behalf of Spire Inc. Because Spire Inc. is going to adopt whatever the capital structure the Commission ordered, according to their own statements. So if you, Commission, give them an overly high capital structure, you're going to be the ones who end up directly hurting ratepayers. But it gets worse than that, because the Commission staff has taken this position that Spire's capital structure should remain the same because nothing has changed since the last rate case. And if you think about it, nothing has changed since the last rate case because Spire is targeting its capital structure. So what this does is it puts customers at risk of the perpetual capital structure. Let me show you a visual diagram of what I mean. It starts up at the top where the Commission approves a capital structure. Then Spire targets that capital structure, as they've already said they are going to do. Spire achieves the targeted capital structure, and the Commission staff, seeing that nothing has changed from what the Commission ordered, recommends they continue the capital structure. And thus you have a loop. At no point ever will customers have any chance of seeing less costly capital based on equity, because they're always going to maintain as high an equity ratio as possible because of this loop. That is the key problem here. What's going to happen if there's no correction? Well, as I already said, Spire, Missouri will never achieve a more cost-efficient capital structure. It doesn't matter how much regulation or legislation occurs that says, hey, it's safe, you can afford more debt. They're going to continue to maintain as high an equity ratio as possible. Second, Spire, Missouri ratepayers are going to continue to subsidize Spire Inc.'s non-regulated business activities. And finally, as I've already said, the Commission is going to remain the de facto business manager, at least with regard to capital structure, of Spire, Missouri. And the Commission will be directly injuring customers if it authorizes an expensive, equity-rich capital structure that the company does not actually need to meet its capital needs. How do we correct this problem? As I've already said, Spire Inc. is actively managing its capital structure. It is doing what a competitive business is meant to do. So, we should use Spires Inc.'s capital structure to guide setting Spire Missouri's capital structure. Stated a different way, you should consider a consolidated capital structure for guidance. Now, I'm going to turn to the second issue regarding capital structure, which is, in many respects, just as big, and that's the inclusion of short-term debt. As I showed you previously, both Spire Inc. and Spire Missouri are consistently funding themselves with approximately 10% short-term debt. This is far greater than any other investor-owned utility operating in this state. Moreover, 30% of this 10%, that's 3% of the total capital structure, is funding QUIP, construction work in progress. This is important because you heard the counsel for staff come up here and say, generally the commission does not include short-term debt in capital structure. That's correct, because short-term debt is generally used as bridge financing for construction, the QUIP. However, the commission has accepted in the past the testimony that says the short-term debt in excess of QUIP, that should be in the capital structure, because if it's not funding short-term assets like QUIP, it's funding rate base. And the point here is that when you look at how much short-term assets the company has compared to how much short-term debt they're carrying, 70% of their short-term debt, or 7% of their overall capital structure, is funding non-short-term assets. It's funding rate base. And that's why it needs to be included in the capital structure. Finally, I want to point out that historically, both Spire East and West have included short-term debt in their capital structure, either by commission order or by the company's own recommendation. Now, there was one point on this issue that really wasn't kind of brought up that I want to address, and that's the company is adopting what I consider to be one of the most egregious and manipulative arguments regarding short-term debt inclusion I've ever seen. It's truly ridiculous. This is what happens. If you go and look at the entire test year and true-up period, and you look at how much short-term assets and how much short-term debt the company is carrying on a month-by-month basis, you will see, as I've already said, that short-term debt exceeds short-term assets by like 3 to 1. Again, it's that 30% I mentioned. Short-term assets only make up about 30% of the short-term debt that's on their books. For 19 and a half out of the 20 months that are in the true-up and test year. In the last half of the last month of the true-up, the company issued long-term debt. And what the company is claiming is that long-term debt issued in the last half of the last month, 11 days, wipes out all the short-term debt across its entire test year. And that's why you shouldn't include any short-term debt. The company is effectively arguing that 11 days in the month of May should set its entire capital structure, and the commission should ignore 19 and a half months of data for no reason. There is no basis in law, fact, or reason for this, and the commission should not do it. When you look at what was actually happening to the company, you will see that 7% of their overall rate base was being funded by short-term debt for 19 and a half out of the 20 months in the true-up and test year period. So, to conclude, the proper, just, and reasonable capital structure that should be adopted for Aspire Missouri is 45% common equity, 45.04%, 47.68% long-term debt, and 7.28% short-term debt. All right, I know I just talked a lot. Don't worry, my slide on return on equity is just one slide. So, as you already heard from staff counsel, we actually are pretty much aligned with staff here. The OPC's range is from 8.5 to 9.5. We are recommending a 9.25, which is exactly what this commission just approved for the Empire District Electric Company. So, nothing new there. Staff's range is from 9.12 to 9.625. So, our recommendation falls within staff's range of reasonableness. Finally, I want to point out, our recommended ROE is already 200 basis points higher than the actual cost of equity for the company. I want to talk about two things here to kind of drive that home. First, if you pick up any certified financial analyst textbook, any basic economics textbook, they will tell you that the rule of thumb for determining the cost of equity for a company is to take the debt issuance by the company and add 3 to 4% as a risk premium, okay? Spire just issued bonds at 3.3%. So if you take that, add 3 to 4%, and you're at 6.3 to 7.3. You add your 200 basis points, and you get to 8.3 to 9.3, which is basically exactly where the OPC's range is, give or take 0.2%. So we are already 200 basis points above what the general rule of thumb tells you their cost of equity is. And that's okay, because as Mr. Murray has testified and will testify, investors expect that the ROEs are going to be set higher a little bit than the cost of equity. Now, they also expect that those are going to come a little bit further down. They're going to get more in line with the cost of equity, but this is already an expectation of investors. But the point is, you don't need a 9.95. That's going way beyond the risk premium that's necessary. Finally, as one last point, our witness, Mr. David Murray, who you will hear from shortly, has based his analysis on actual practical investment analyst data and assumptions. He's, I believe, the only person to have done that. And that is why you should listen to him when it comes to this issue. I have nothing else to add. Are there any questions?
No questions. Let's get to our first witness. Mr. DeSantis, would you please make your way to the witness stand? Please raise your right hand. Do you solemnly swear or affirm to tell the truth during your testimony in this hearing?
I do.
Thank you. Please have a seat and state and spell your name for the court reporter.
Sure. My name is Dylan W. DeSantis, D-Y-L-A-N, D''A-S-C-E-N-D-I-S.
Thank you. And Spire's witness.
Thank you, Your Honor. Mr. DeSantis, would you, again, please state your name and your business address for the record?
Yes, my name is Dylan DeSantis. My business address is 3000 Atrium Way in Mount Laurel, New Jersey.
And by whom are you employed, and what is your title?
I'm a partner at Scott Madden, Inc.
And are you the same Dylan W. DeSantis who caused to be filed direct rebuttal and surrebuttal testimony in this proceeding on December 11, 2020, June 17, 2021, and July 14, 2021, respectively?
Yes.
Do you have any additions or corrections to make to your testimony at this time?
I don't.
If I were to ask you the same questions again that are posed to you in your direct rebuttal and surrebuttal testimonies, would your answers be the same?
They would.
Okay. And are those answers true and correct to the best of your knowledge?
They are.
Thank you. At this time, I'd like to move the commission to enter all of Mr. DeSantis' testimony into the record. I believe they've been marked as exhibits 5, 6, 7, which is a public version, and another 7, which is a confidential version.
The parties have heard the list of exhibits. Are there any objections? Hearing no objections, it is so admitted.
Thank you, and I'd like to tender Mr. DeSantis for cross-examination.
And we'll go to Mr. Thompson of State.
Thank you. Good morning, Mr. DeSantis.
Good morning.
You heard the, opening statement given by Mr. Kleiser, is that correct?
I do.
Do you agree that the appropriate rate-making capital structure is 45.04% equity, 47.68% long-term debt, and 7.28% short-term debt?
I don't.
Why is that?
Well, I'm relying on the testimony of, Mr. Woodward, but, the proposed capital structure that Spire and, the staff has pretty much agreed to, at least in my testimony, they're comparable, to the equity ratios and capital structures maintained by, both the holding company proxy groups and the operating company proxy groups. So in my portion of the testimony, which was looking at the reasonableness of the company's request, it looks like they're comparable in my view.
Thank you. And if the commission were to adopt the capital structure suggested by the Office of the Public Counsel, rather than the capital structure suggested by the company and the staff, would that result in a lower revenue requirement?
I'm not sure, but, I mean, the key to the thing is I think Mr. Caro said in his opening statement that Spire Inc. has five different gas companies, a pipeline company, and non-regulated businesses. So it doesn't reflect, the Spire Inc. capital structure doesn't reflect, Spire Missouri's operations. What Mr. Woodward correctly did and what Dr. Wan correctly did was they looked at what finances the rate base, and that is the actual capital structure of Spire, Missouri.
Let's talk about what finances the rate base. Mr. Kleiser indicated that it is OPC's belief that 70% of the short-term debt carried by Spire, Missouri, is used to finance the rate base. Is that correct?
I wouldn't know for sure, but in general, when you talk about financing rate base, you talk about the matching principle, and that the debt would match the life of the investment. So if your assets are long-term in nature, you wouldn't finance them with short-term debt.
Thank you. No further questions.
Thank you.
Mr. Kleiser, your witness?
Nothing, thank you, Your Honor.
Thank you, and again, I would state for the record, we have all of our commissioners either on the WebEx or in a shared office or listening on the live stream. If you are on a phone, it is *6 to unmute. Are there any commissioner questions for witness DeSantis? I don't hear any. The judge doesn't have any questions. That takes us back to redirect.
No questions, thank you.
Thank you. You are excused.
Thank you. Have a good day.
You as well. Mr. Woodard, please come on down. Please raise your right hand. Do you solemnly swear or affirm that the testimony you give in this hearing will be the truth?
I do.
Thank you. Please have a seat. If you would state and spell your name for the court reporter.
Adam, A-D-A-M-W, Woodard, W-O-O-D-A-R-D.
Spire's witness.
Thank you, Judge. Would you please state again your name and business address for the record?
Adam Woodard, business address is 700 Market, St. Louis, Missouri, 63101.
And Mr. Woodard, by whom are you employed and what is your title?
I'm the Chief Financial Officer of Spire, Missouri, and the Treasurer of Spire, Inc.
Are you the same Adam Woodard who caused to be filed rebuttal and surrebuttal testimony in this proceeding on June 17th, 2021, and again on July 14th, 2021, respectively.
I am.
Do you have any additions, corrections, or deletions to make to your testimony this time?
I do not.
If I were to ask you the same questions again today that are in your testimonies, would your answers remain the same today?
They would.
And are they true and correct to the best of your understanding?
They are.
Thank you. At this time, I'd like to move the commission to enter all of Mr. Wood's testimony into the record as exhibits. They have been marked as Exhibit 45, Exhibit 44, Exhibit 45, which is a public version, and Exhibit 45C, which is a confidential version.
Are there any objections to the admission of Mr. Woodard's various testimonies? No objection is heard. It is so admitted. Go ahead, Mr. Carroll.
Thank you, Judge. At this time, I'd like to tender Mr. Woodard for cross-examination.
Mr. Thompson?
Thank you. How you doing, Mr. Woodard?
I'm great. How about you?
I'm okay, thanks. Now that I got a computer that works. I guess you must be Spire's capital structure witness, is that correct?
I am.
Okay. So you were here and listened to Mr. Kleiser's opening statement? And you've also read the testimony of OPC's expert, David Murray?
I have.
Okay. So let's zero in on that short-term debt. Do you agree that 70% of the short-term debt held, I guess, by Spire, Missouri, is used to finance rate base?
No, it is not.
What is it used for?
Short-term debt is used, we issue short-term debt almost daily, and is used to support short-term assets primarily, and then is bridged into longer-term, as we put assets into rate base, bridged into longer-term capital, long-term debt.
Is it your professional opinion that short-term debt should be included in the rate-making capital structure?
No, it is not.
And if you know, can you tell me whether the adoption of OPC's proposed capital structure, as opposed to the capital structure recommended by Spire and staff, would that result in a lower revenue requirement?
Yes, it would.
Would that make it more difficult for the company to achieve its commission authorized rate of return?
Yes, it would.
Would that deprive the company of necessary cash flow?
Yes.
Now, in the opening statement that Mr. Kleiser gave, there was discussion about a dangerous circle where you would have the capital structure approved by the commission would again approve your capital structure, and I guess that would continue forever. Did you hear that?
I did hear that.
And did you see the slide that?
I did review the slide.
Okay. Is it your professional opinion that in fact that is a danger?
No.
And why is that?
That's a theory that's been offered by Office of Public Counsel that I don't ascribe to.
As business and economic conditions change, do you believe that Spire, Missouri would alter its capital structure in response?
It can, yes.
So would I be right in thinking that conditions might change in such a way that the company would want to have less equity in its capital structure?
There are conditions that would allow for that.
And are there conditions that might occur where the company would choose to have more equity?
Absolutely.
Does Spire, Missouri receive any debt capital from Spire, Inc.?
No, it does not.
Spire, Missouri issues its own debt?
It does.
Did you hear Mr. Kleiser say that if the commission adopts the capital structure recommended by Spire and staff, that Spire Missouri's ratepayers will continue to subsidize Spire Inc.'s non-regulated business activities. Did you hear that?
I did hear that.
In your professional opinion, is that in fact true?
It is not.
Do you believe that Spire Missouri does subsidize Spire Inc.'s non-regulated activities?
No, it does not.
And you understand that that would be improper if it did occur?
Absolutely.
And you also heard from Mr. Kleiser, did you not, that the commission, by adopting the capital structure suggested by Spire and by staff, would become Spire Missouri's de facto business manager?
Yeah, I wasn't totally sure what that meant.
Okay, I won't ask you about it then. Thank you very much, sir. I have no further questions.
Thank you.
Mr. Kleiser?
Thank you. Good morning, I'm sorry, how do you pronounce your last name?
Woodard.
Woodard? Okay, thank you. I apologize. I want to make sure I got it correct. Mr. Woodard, you are the treasurer of Spire Inc. and the majority of its subsidiaries, correct?
I'm the treasurer of Spire Inc., and I'm the chief financial officer of Spire Missouri, Spire Alabama, and Spire Gulf.
Are you also serving as the treasurer of the majority of their other subsidiaries?
Yes.
Thank you. What is Spire Inc.'s current S&P credit rating?
Spire Inc.'s current S&P credit rating.
Yes.
It is triple B plus.
I'm asking you for the credit rating of the issuer, not of their bond.
Well, the credit rating is useful only as it's applied to securities.
What is the current S&P credit rating of Spire Inc. as an issuer?
As an issuer,
Yes.
it is A minus.
What is the current S&P credit rating of Spire Missouri as an issuer?
It is A minus.
It is correct that S&P's indicated anchor rating for Spire Missouri is A plus, correct?
It is.
It is. Is Spire Missouri's S&P anchor rating the same as its standalone credit rating?
I'm sorry, can you repeat that?
Is Spire Missouri's S&P anchor rating the same as its standalone credit profile?
I don't have that in front of me, I'm sorry.
That's fine. Your Honor, I'd like to mark an exhibit, which I believe, hopefully, if I've gotten this right, 234?
Yes, 234. So marked, go ahead. Thank you, sir.
So what are you referring to? I'm sorry.
Hold on one second, because I have to lay the foundation for this. I'm going to wait until it's fully passed out. All right. I think we're ready to proceed. Mr. Woodard, you would agree with me that this is a response to Office of Public Counsel data request 3043, provided by Spire Missouri?
I'd like to stop for just a second. I noticed the word confidential. As soon as I turned the page at the top, I'm just looking to the company for any indication or maybe a discussion with Mr. Kleiser.
Your Honor, I believe that this witness is exceptionally well qualified to handle the confidentiality issue that may be at play.
Sure.
Okay, go ahead.
I am going to proceed slowly just in case. As far as the foundation goes, you were the one who signed this DR, correct?
Yeah, I am.
All right. So starting with the S&P report for Spire Missouri, turning to page 8.
Got it.
You would agree with me again, is Spire Missouri's S&P anchor rating the same as a standalone credit profile?
The Spire standalone group credit profile is A minus. So yes, the standalone credit profile is A minus.
It is correct that S&P adjusts Spire Missouri's standalone credit profile 2 notches downward due to its status within the overall Spire Inc. group, right?
I think we've gone through this in prior testimony, back and forth, and I would disagree with that. You're using group credit and issuer credit profiles. Those are not used by the capital market.
All right, well, at a minimum, you would agree with me that under standalone credit, on the bottom of page 8, it reads standalone credit profile A+, group credit profile A-, entity status within group core, and then parentheses, -2 notches from SACP, which again would stand for standalone credit profile. You would agree with me if that's what the paper says? Thank you. You have a copy of your servo?
I don't. Or maybe I do, sorry.
You turn to page 8 for me. You there?
Yep.
Starting at line 23 of page 8 and continuing to line 6 of page 9, would you agree with me that it reads, there are a number of factors that underpin S&P's rating methodology, including liquidity, governance, regulatory consistency, financial stability, and operating efficiency. S&P tracks numerous financial metrics.
I'm sorry. Can you read just a little slower?
My apologies. Should I start over from the beginning? There are a number of factors that underpin S&P's rating methodology, including liquidity, governance, regulatory consistency, financial stability, and operating efficiency. S&P tracks numerous financial metrics besides the capitalization ratio and also reconciles a company's posted financial statements to its preferred presentation before judging any metrics. Unfortunately, Mr. Murray dwells on only one of many factors, capital structure, which he fails to accurately explain while ignoring the other factors involved in such an analysis by S&P.
Some of that, I just want to be cautious here because I saw some of that. Is some of this considered confidential, as Mark was confidential?
Oh, I do apologize. I actually didn't see the double asterisk at the beginning.
Go ahead.
My apologies to the company. We're here now. Go ahead, Mr. Kleiser.
The reports, analyst reports are under paywall, so there's disclaimers on use of them.
I'm sorry. Can you speak up, please?
Analyst.
All right. If we compare page 8 of the Missouri S&P report to page 8 of the Spire Inc. S&P report, you would agree with me, for example, that the country risk is the same.
I don't have the Spire Inc. report in front of me.
It's attached to the back of the,
The one you gave me before?
yes, both of them are in there.
They're both in the same exhibit.
Yep.
Okay.
you would agree with me that comparing Spire, Missouri to Spire Inc., the country risk is the same,
Yes,
and the industry risk is the same.
yes,
The competitive position is the same,
yes,
and the diversification portfolio effect, which is on page 8 of Missouri and page 9 of Spire Inc., is the same.
yes,
And the financial policy is the same,
yes.
and liquidity is the same.
You skipped over one.
I did skip over one, but you would agree the liquidity is the same,
Yes,
and the management and governance is the same,
yes,
and the comparable rating analysis is the same.
yes,
And the only difference is the financial risk, or rather cash flow / leverage,
yes.
which is significant for Spire Inc. and intermediate for Spire, Missouri.
You did skip over one though, right?
I believe I skipped over cash flow / leverage.
Capital structure.
Well, that's the one we were referring to.
Okay. So what's,
That is the only difference.
the capital structure is the only difference?
Yes. Oh, I see. I apologize. You would agree with the capital structure is the same.
Yes, but they both stay neutral, no impact.
Right. The cash flow / leverage is the only difference.
For the financial policy,
For the rating score snapshot, the only difference between Spire, Missouri and Spire Inc. with regard to their issuer credit rating is the cash flow / leverage
under financial risk,
under financial risk, yes.
yeah, one is significant. One is intermediate.
Which one's significant and which one's intermediate?
Spire Inc. is significant.
Would you turn to page 16 of your survey? Now, this time, I do see that there is some confidentiality here, which I'm about to question about, so please give me one moment, Your Honor.
For those on WebEx or listening on the live stream, the attorneys are conferring about some confidential information.
In order to avoid confidentiality and having it go on camera, this question is posed in reference to lines 3 through 13 of page 16, and I will assume that the parties will be able to read the testimony and get at what I'm intending to ask. Mr. Woodard, you would agree with me that Spire Inc. is currently committed to maintaining its current investment-grade credit rating of A-.
Spire Inc.'s current rating of A-. I don't regard Spire Inc. having a current rating of A-. I regard it as a bond rating, which is triple B+.
I'd like to mark another exhibit, should be 235.
And that,
Mr. Wood, do you agree with me that this is a copy of a financial strategy presentation provided to Spire Inc.'s Board of Directors on December 21st that was provided in response to OpenSea data request through 3036?
Yes. And before we go further, Your Honor, I'd like to note that this is marked at the top of the document as attorney-client and work product privilege.
So noted.
All right, unfortunately, Your Honor, I'd like to go in camera for one question. I apologize. Or alternatively, the question is just to identify a statement in the document itself that's been provided by Spire. I mean, I can just move to admit the document, and we won't have to ask the question on the record. Because
I will state again, the commission has a strong position on keeping all of its proceedings in the public eye. If there is a possible way for you to ask that, and I would look to Spire, I'll let the attorneys talk.
turning to page 13 of the document, and reviewing that first bullet point, does that change your answer to the previous question?
No.
I'm just going to go ahead and offer 234 and 235 and see if I can close down this line of questioning. I will address my point more thoroughly in the brief.
Okay, we're gonna go one at a time.
Absolutely.
We have Exhibit 234,
Which probably should be marked confidential.
Which is 234.
that's data request 3043.
Yes, the S&P report should be marked as confidential, no objection.
Exhibit 234 confidential, marked as confidential, is data request 3043. Are there any objections to the admission of Exhibit 234 marked confidential?
No.
No.
No objection.
So admitted. Exhibit 235, which will also be marked confidential. I'm looking for confirmation.
Yes.
Your Honor, what I would suggest is that on Exhibit 235, the exhibit, the title page of the presentation, and then page 13, which is the page that was referenced with the witness only.
There are additional questions I have for other witnesses on this issue that refer back to this document.
Let's add pages as we get to them.
I would prefer to take the entire document. Consider it the requirement of having a complete record.
Why?
You yourself pointed out the other day of having a complete record. Well, I can't remember the other day, it was the day previous.
Yes.
I mean, it's just.
That's just a phrase, Mr. Kleiser. Why is this entire package being added, making a complete record? And in the alternative, Mr. Appleton, why doesn't a highly confidential designation satisfy?
Your Honor, the document is marked as both attorney-client privilege and work product privilege. I would prefer that if we're going to use it, we only use those pages that have actually been asked about and have actually proceeded into the record.
This document outlines Spire Inc., let me be clear, financial strategy planning for the test year period, and it reflects specifically on the OPC's argument regarding the fact that Spire Inc. is seeking to subsidize itself through Spire, Missouri. As far as regarding privilege, that was waived for production of the document.
I'm going to take that under advisement. For now, we're gonna go one page at a time. And I'll decide about the SR 2021 Financing Strategy Board Education December 2020 document at a later point in time. Let's move forward. We have our one-page 13 so far. We're gonna have each of these as a standalone exhibit. So Exhibit 235, marked confidential, consisting of 2 pages, the cover page and page 13, which Mr. Woodard was just questioned about. Are there any objections to the admission of Exhibit 235 as I have defined it?
As marked confidential.
As, yes.
No objection.
Hearing none, so admitted. Mr. Claus, your witness.
Thank you, Your Honor. I hadn't intended to cross on this point, however, given Mr. Thompson's line of cross, can you please turn to Schedule AWWSR2? With regard, and I'm not even sure if it's confidential, but just to be sure, I'm not going to refer to specific numbers. With regard to the pro forma long-term debt issuance, when was that debt issued?
That issue was in the second week of May, 2021.
It was not issued in September of 19. Correct?
The pro forma long-term debt issue on this, referred to on this page,
Yes.
that was,
It was not issued in September of 19.
no.
All right, thank you. Do you have a calculator?
I don't.
Can you pull up the calculator on that computer in front of you? For September of 19, on this schedule, what percentage do the assets supported by STD, which stands for short-term debt, make up out of the average notes payable? I want just those 2 numbers.
The assets, you want me to calculate it?
Yes,
Why
please.
don't you just give me the calculation?
I honestly don't have it in front of me.
Okay?
You know, can we reference a page number of this exhibit and what you're referring to?
Page 1 of the schedule, September 19 column.
And so what number would you like?
The assets supported by short-term debt out of the average notes payable.
So you're doing it on a calculator, but you want me to do it on a calculator too?
Yes.
Assets supported by short-term debt, what's the other input that you'd like?
Average notes payable. you agree with me that it's about 23%?
Yes.
Okay, thank you. Would you agree with me that if we were to do the same calculation for all the other months before May, we'd come to a roughly similar number?
The month before May of 2021?
2019 through 2020 through 2021, all the months that are on this schedule. If I take the assets supported by short-term debt, I'd say what percentage of that it makes up the average notes payable, it's gonna be in a 30% range. Would you agree with that?
I haven't done all the calculations. But it sounds like you have.
Yes.
Did you have something to bring in and support for that?
I don't need to. You have presented the schedule.
I presented the schedule as is.
You would agree with me that if you remove that pro forma adjustment that you made December 19th, only about 23% of your short-term assets would be supported by the short-term debt would only support about 23%.
You want me to remove something from the schedule that I offered?
I want to point out that if you remove that pro forma adjustment, which didn't happen until May, 70% of your debt was supporting rate base.
That's untrue.
Just did the math and showed that it was true. If you remove that pro forma adjustment, 70% of your assets was not supporting short-term debt.
And those assets are in rate base.
Disagree.
I'm sorry, you're asking to change a schedule that I offered. I don't really get where you're coming from.
Yeah, that's fine. I'll explain it in the brief if necessary. No further cross.
Thank you. That brings us to commissioner questions. Are there any commissioners that have questions for Mr. Woodard? Hearing none, the judge does have a few questions. I'm looking for two numbers, Mr. Woodard. What was Spire, Missouri's short-term debt as of 2 days? As of December 31st, 2020, and as of May 31st, 2021.
May 2021 at the true up, $433,525,000.
I'm sorry, I couldn't hear that number again.
$433,525,000.
And that was on what date?
That's actual May 2021 at the true up. Average notes payable, it's on page 7 of AWW SR2. I got out of date here. I think I'm missing a page. I apologize, Judge. Can someone supply page 4 for the December number? Thank you. Lining this up there. December 2020, average notes payable, $393,600,000. $675,000.
Thank you. Do you know what percentage of Spire Inc.'s consolidated structure is allocated to non-regulated businesses?
Percentage of our capital, I'm sorry.
Of your consolidated structure. So I believe at the holding company level, that capital structure, and then what percentage of that is allocated to non-regulated entities?
Yeah, so we think about the non-regulated entities, and it's cited in the rating agency reports as being less than 10% of the overall company. I think that's an appropriate way to think about it. Each individual regulated or non-regulated company has a different cap structure. Sometimes they're just book cap structures inside of the holding company. For instance, Spire Marketing has 100% equity from a non-regulated business.
Okay. I'm going to switch to some legislative changes, and I'm just going to talk about the gas ISRIS. Are you familiar with them?
Yes.
Okay. For everyone listening online, this is a piece of legislation that went into effect August 28th, 2020. Mr. Woodard, have those changes to the statute increased the number of projects or replacements that Spire can recover through the infrastructure system replacement surcharge, ISRIS?
Has it replaced or
Has it increased the number
of projects? It allows us to particularly, well, ISRIS is for pipeline replacement, and as much as we're trying to get that done more quickly, you know, that has stepped up over the last handful of years.
Now, my question is, did this legislation increase the number of projects that you can do? Did it
The
help?
most recent legislation,
Mhm.
we have not filed that.
2020.
We have not filed an ISRIS under that legislation yet.
I understand. Hypothetically, did the legislation increase that number of projects?
It could.
Okay.
It could.
Did you do any calculations on your return on equity to account for that potential increase from the new legislation?
The impact of the new legislation on return of equity, no.
Okay.
No.
Can I ask why not?
I think it's an interesting suggestion, but it's not something that I don't think it would materially change what our plans would be. Again, these are pipeline replacement we're undertaking really for the safety and soundness of the system, and so we'd like to do it as quickly as we possibly can in a reliable and balanced way. So that is I don't think the new legislation would change our plans materially one way or another, but it could step up the pace a little bit.
Is our discussion in the last few moments the first that you have considered if this rate case would be impacted by that legislation?
If this rate case would be impacted by that legislation, I had not really thought about its impact on this, but that would be correct.
Okay. I believe this is my last question. There has been a lot in testimony and said today about Spire, Missouri's capital structure. I have 3 questions. No surprise. I'm just going to give them all to you at once, and then you take them. Is Spire, Missouri keeping its capital structure at a certain level on purpose? What are the benefits if that is what's happening, and what are the risks?
Great question, Judge. We do actively manage Spire Missouri's capital structure, and I would point out that at times, we exceed the equity that we're asking for here, and that's apparent in the schedules as well. We feel like we're striking the right conservative balance with the capital structure, in that we are providing a economic product to our ratepayers, and then also bolstering the resiliency and sustainability of the company as well against market, unforeseen market issues, unforeseen operational issues. One of those being, just in the true-up period, Winter Storm Uri impacted utilities throughout the mid-continent, including us. Fortunately, we were less impacted than some of our peers, than some of the rest of the peer group. We're able, and I would point out that some of the peers were able to more fully withstand very significant operational impacts because they had high equity capital structures in their cap structure. So it's we really do look at that balance when we're coming to managing to the right structure. And then Spire Missouri is issuing its own debt, and then we're retaining equity, and that alone is we're able to support the capital program that we've undertaken, that we just talked about, that goes into quite a bit of, several years into the future as well. So that it does allow for, we feel, a balanced cap structure for that financing on a go-forward basis that will be required to go through these system replacements.
Is there a downside?
We don't think so.
When I first started looking over this issue that was raised, I saw it as two. Is Spire Missouri targeting a specific ratio, and is that a problem? And what occurred to me was an analogy with the speed limit. Mr. Kleiser has posited that what I would say setting the speed limit is the commission being in charge of setting the company's business decisions. And I haven't been able to shake that analogy. Would you educate me on if I'm wrong on that?
Setting the speed limit as far as, it's a curious, I think in most instances, utilities are encouraged to have a fairly robust capital structure because we are, by our nature, are more conservatively managed. And so that you do have a benefit of that in your cost of debt. We can raise debt more cheaply that way. It does, it impacts our ability to access the market. As far as setting like I just mentioned, setting a speed limit, certainly market conditions could dictate potentially lower capital structure. This is just a curious point in time to take that tack as well, given that we are at a point in the market where there's still some very significant equity dislocation that's been written about by all the parties to this testimony, and that's not, that doesn't suggest lowering or leveraging up the cap structure for the benefit of ratepayers. That is more suggestive of taking on more risk for ratepayers, and I think it would, in the end, add more costs to ratepayers, not decrease costs to ratepayers.
Okay, that's all the questions I had. That does trigger our recross, and that would go to Mr. Thompson first.
No questions, Judge, thank you.
Mr. Kleiser?
Mr. Wood, you would agree with me that having a higher equity ratio increases your overall revenue requirement, right?
Correct.
You would agree with me that a higher revenue requirement increases the amount of funding that goes to your shareholders?
Yes.
You're a sole shareholder in this case. The sole shareholder of Spire Missouri is its parent, Spire Inc.
Well, it increases the funding that goes to the organization. It doesn't necessarily increase the dividends with Spire Inc.
I believe you mentioned Spire marketing in conversation with the judge, is that correct?
Correct.
Spire Inc. has been increasing its parental guarantees to Spire marketing, correct?
That's true.
No further questions, thank you.
Redirect, Mr. Carroll?
Yeah, just a couple of questions. Mr. Woodard, Hope and Bluefield cases allow a return that maintains financial integrity. And, would maintaining an A- rating, would that be the goal of the commission as well?
We'd like to maintain our current rating, yes.
We talked about short-term debt. 2 dates, does not reflect the fluidity of the short-term debt over the year, does it?
It doesn't. In fact, we modeled, in my testimony, the approach that the commission took last time that they described as a point-in-time analysis. And so we offered that up again, obviously, because that did go into our thinking of how to think about short-term debt and manage short-term debt appropriately.
Also, it does not finance rate base, does it?
It does not.
And, one other, question, ISRIS is common, a program such like, as that is common in the proxy group, so there would not be a meaningful difference in ROE, would there?
No, it's not. Those kind of riders are very common within the proxy group.
And can you please explain some of the, uses of short-term debt?
Short-term debt is typically, as was referenced by Mr. Kleiser, fund construction work in progress, but also other short-term assets. One of the reasons why it's fairly high in May is that we continue to hold balances from the winter storm Uri, fairly significant balances, and that is another use of short-term debt to carry those balances.
Thank you, no further questions.
Thank you, Mr. Woodard. You are excused. I'd like to take our break now. We have 2 more witnesses. We've been going for about an hour and 35 minutes. This seems like a good halfway point. 10:35 now. Let's call it 10:45. 10 minutes. We're at recess and off the record. Let's go back on the record, the recess having expired. We are on our final two witnesses for the last issue of the hearing in Spires general rate case, that is captioned GR-2021-0108. Currently, we are on cost of capital. This is issue number 1, and we are ready to take testimony from Dr. Wan. Dr. Wan, please raise your right hand. Do you solemnly swear or affirm that the testimony you give in this hearing will be the truth?
Yes.
Thank you. Please have a seat and state and spell your name for the court reporter.
My name is Sung Jun, S-E-O-U-N-G, space J-O-U-N, and Wang, last name Wang, W-O-N.
Staff's witness.
Thank you, Judge. Dr. Wan, tell me how you're currently employed,
Missouri Public Service Commission,
and what is your title?
Regulatory Compliance Manager.
Are you in fact in charge of the group that does financial analysis?
Yes,
And did you prepare or cause to be prepared exhibits 124 rebuttal testimony and 139 rebuttal testimony?
yes,
And did you contribute to exhibit 101, public and confidential staff's revenue requirement cost of service report?
yes,
And do you have any corrections to any of those?
yes, I have.
I think I have copies of your corrections. Do you have a copy of yours? Of your corrections?
Yes,
Okay.
so I have some.
Just a moment. Let me hand these out so that our viewers can read along with us. How many you need, Judge?
Just one.
No need any?
Thank you.
Anybody else? I've just handed out a sheet that's marked error correction Sung Jun Wan. Should we mark this as an exhibit, Judge?
I was going to ask you first.
Okay.
Yes.
I would be most comfortable if we did. Let's see if I can figure out I think staff's next exhibit is 144.
That's also what I have.
Okay, so, looking at staff exhibit 144, you have 6 corrections marked on here, is that correct?
Yes,
And that would be in the revenue requirement cost of service report, page 18, line 21. Instead of 2028, it should be 1928.
yes,
And in Appendix 2, Schedule SJW-11, first table, row 3, column 1, instead of 0.2%, 2.00%.
yes,
And Appendix 2, Schedule SJW-11, footnotes 1, 2, 4, and 5. Instead of 2021, it should be 2020 and 2021.
yes,
And in Appendix 2, Schedule SJW-12, first table, instead of 10/01/20 to 12/31/21, it should be 1/1/21 to 3/31/21.
yes,
And in Appendix 2, Schedule SJW-13, first table, instead of June, July, and August 2020, it should be January, February, and March 2021.
yes,
And in rebuttal testimony on page 17, line 10, instead of figure 4, it should be figure 5.
yes.
Do you have any other corrections or changes to your items of testimony that I listed?
No,
those corrections in mind, if I asked you the same questions today, would your answers be the same?
Yes,
And are they true and correct to the best of your knowledge and belief?
yes.
At this time, Your Honor, I would move the admission of Staff Exhibit 101, PNC, Staff Exhibit 124, Staff Exhibit 139.
And Exhibit 144.
And Exhibit 144, I'm sorry, thank you.
Okay, I am going to repeat that as the council looks over their notes. I have Exhibit 101, that is the staff report cost of service. Any objections to the admission of Staff Exhibit 101? Hearing none, it is so admitted. We will take the testimonies together as one question. Are there any objections to the admission of Dr. Wan's various testimonies, which are marked as Exhibits 124, 139, with corrections on Exhibit 144? Any objections to any of those?
No objection.
No objections heard, it is so admitted.
Mr. Thompson?
Thank you, Judge, and I wonder if I could ask your indulgence. I noticed that Exhibit 104, P&C, which is staff's class cost of service, a great design report, has not been offered or admitted. That is a crucial piece of testimony, and I wonder if I could offer that at this time.
I think you can. Exhibit 104 has been offered into the evidentiary record. Are there any objections?
No objection.
None heard, so admitted.
Thank you very much. I tender the witness for cross-examination.
We'll go to the company. Mr. Carroll?
Thank you. Good morning, Dr. Wan.
Morning.
My name is Frank Caro, and I'm counsel on behalf of Spire, Missouri. I want to turn to your testimony. I believe it's SJW 15 is an exhibit.
Yes,
In there, you are recommending an ROE of 9.37%, correct?
yes.
Now, please turn to page 6 of your rebuttal testimony, beginning at line 2.
So, which
Yeah,
page?
page 6 of your rebuttal, beginning at line 2. There you compare Mr. DeSendis' recommended ROE of 9.95 to the average authorized ROEs granted to other utilities in 2020. You see that?
Pages 6, 9, 2, and line 3.
Line 2.
So I think line 2 and line 3, I said, what you said.
Okay, so my question is, you compare Mr. DeSendis' recommended ROE of 9.95 to the average authorized ROEs granted to other utilities in 2020. Is that correct?
Yes,
Thank you. And you state that the average authorized ROE for fully litigated cases in 2020 was 9.44%. Is that correct?
Yes,
And you cite the S&P Global Market Intelligence as the source of that information. That's in footnote 10 down below. Do you see that?
yes.
Judge, I'm going to mark an exhibit. I believe it's exhibit number 51.
That's what I have, so marked.
Okay. May I approach the witness?
Sir.
Dr. Wan, I've handed you what's been marked as Spire exhibit number 51. Are you familiar with this report?
Yes,
And it is the July 27, 2021 regulatory focus report published by S&P Global Market Intelligence, is it not?
yes.
Yes, okay. And this is a more recent version of what you cited in your testimony, isn't that correct?
I cited by basic level of data, but I think this result is consistent with that data.
And so what is the average ROE authorized for gas utilities for cases decided in the first half of 2021? I'll point to you, in general rate cases in 2021, the number 9.62%. Is that correct? If you, I can highlight that so we can.
Yes, please.
So my question is the average for the first half of general gas rate cases is 9.62, correct?
Yes,
And for the fully litigated cases, it's 9.61, correct?
yes,
So that would indicate that gas ROEs are trending higher, is that correct?
for first quarter 2021. But I calculated second quarter 2021 results that
I'm
goes
sorry.
down.
I'm sorry, you said you what, and
I calculated second quarter 2021 authorized ROE results that goes down.
And do you have that number?
Yes,
And what is that number?
average 9.48.
And where is that published?
This is basic level of data of S&P global.
This report, exhibit number 51, is dated July 27th, 21.
Yes,
That was 10 days ago, correct?
yes, and then that report about first quarter. And then my number, that is second quarter vision.
Okay, if you look at the same report that I just handed you, and it says LTM ended 6/30/2021, and that number is what on that report?
Mr. Carroll, where are you looking?
I'm on the exhibit 51, on the first page, Judge, and you see a number, first half of 2021, 9.62 of general.
I see it, the date column.
Yes.
Okay, thank you.
And then you talking about next column,
Yes,
so that number, general rate cases, 9.55, fully litigated cases, 9.56. That means after first quarter, averages decrease. That means second quarter number is decreased.
but the first column there, the middle column says the first half of 2021. Isn't that correct?
Yes, you are right.
This time I move to admit exhibit number 51.
Any objections? None heard, so admitted. Go ahead.
Thank you. It's been brought to my attention that this exhibit should be marked as confidential also, Judge, because of the information on the back of it.
Thank you, and I failed to note for the record, Exhibit 51 is confidential. Exhibit 2, confidential, so marked. Go ahead.
Thank you. Mr. Wan, let's turn now to your analysis. In order to arrive at staff's recommended ROE of 9.37, you compare the results of staff's 2017 DCF and CAPM models as corrected to the results of staff's 2021 DCF and CAPM models, and determine that the average difference in the models from 2017 to 2021 was negative 43 basis points, correct?
Yes,
Is that stated, that is set out in your exhibit schedule SJW-15, correct?
yes,
And then you subtracted the 43 basis points from the 2017 allowed ROE of 9.8% to arrive at staff's recommended number of 9.37. Is that a fair summary?
yes,
A summary of those results, as I said, is set forth on SJW-15, correct?
yes.
Let's look at SJW-15. Noting that the average result of the 2017 models was 7.68%. The average result of the 2021 models was 7.25%, referring to A and D on the schedule, Judge.
Thank you.
The difference between the 2017 and the 2021, numbers is negative 0.43%. In 9.8% less 43 equals 9.37%, correct? That's how you arrived at that number?
Yes, sir.
I want to also look at number G. There's a note on the bottom of that exhibit there. And it says that to arrive at G, you subtract F minus C. Is that right?
No, it's wrong.
It's wrong, okay. What should it be?
It should D minus A.
Okay. So we should correct that on the schedule.
Yes.
If we look at the difference between the estimated cost of equity in 2017, line A of that exhibit, okay, and the authorized ROE in 2017, line H. So looking at exhibit number SJW 15, again, we're going to stay with 15.
Okay.
And you're looking at line A, and the authorized ROE in line H, okay? We take 9.80 and minus the 7.68, and you get to 2.12, correct?
Excuse me.
So line A,
Line A.
right, and then
Yes.
you subtract line H,
Yes.
and you get to 2.12%, correct?
Yes.
So if we look at the difference between the estimated cost of equity in 2021, line D now, okay, and the recommended ROE in 2021, line I, so that we take the 9.73% minus the 7.25%, that equals 2.2%, correct?
So
Line-
0.12?
Yes.
Yes.
So another way to view staff's methodology is to add 2.12% to the average results of staff's DCF and CAP-N model, correct?
So brief calculation, yes, you're right. But steps authorized ROE is not simple calculation. This is just estimation procedures.
Thank you. Let's look at your exhibit SJW 13. Excuse me, let's turn to SJW 12 first, okay? So if you turn to SJW 12, your exhibit, you use prices for your proxy group for April through June of 2017 and January through March of 2021, correct?
Yes.
And you provided value line work papers to the company in response to discovery, is that correct?
One of value line report, yes.
Yeah.
I'm
And
sorry?
those,
One of value line report.
I want to give you, I'm going to give you back the value line work papers you produced. And so they are They are the value lines for December of 2016 and August of 2020. Those were the work papers that you provided, correct?
So yes,
So you would agree that your 2017 value line work papers are actually dated December 2016?
so that is what I have, yes. The last case, work paper.
Any objections with me?
No, those are his work papers, right? No.
So you would agree that your 2017 value line work papers are actually dated December 2016, correct?
So I do not know the exact day of publication.
Okay, it's on the bottom of each of those value lines, the very bottom, it should be a date. One says.
Yes, December 2nd, 2016, yes.
Similarly, your 2020 value line work paper is from August 28, 2020, correct? I don't know that you have that. And that was provided, I think it's referenced in, Mr. DeSantis's direct testimony, in Exhibit D-3,
Yes,
which is approximately 6 months before the price date, correct?
yes, you are right.
So I'm handing you, the value line sheets from June 2017 and from February 2021. May it please the commission, we're gonna mark these, as
53 is my next number.
53, which would be the June 2nd, 2017. And the February 26th, 2021 is 54.
Are these confidential?
No, these are value line reports.
Okay.
May I approach?
Oh, yes, please. Thank you. Thank you.
Dr. Juan, I handed you what's been marked as, the value line sheets with concurrent data with your price data, specifically June 2nd, 2017, which is marked as Exhibit 53, and the February 28th value line reports marked as Exhibit 54. Would you agree that these are the sheets are concurrent with your price analysis in SJW-12, which is your exhibit?
I agree.
And just so for the record, people know what are in these reports, these are these reports that are in these exhibits make up the proxy group, do they not? The proxy group of companies that are used in the DCF analysis, correct?
Yes,
And they're in alphabetical order.
yes,
Yes. Do you agree that the value line data may change over time? For example, in 6 months, the data changes, right?
I agree.
So I'll give you a couple of examples. Could you please look at the value line sheet for South Jersey Industries? In December, it would be the December 2016 value line report, which was part of your work papers. So we're gonna compare the December 26 value line, work paper for South Jersey Industries to the June 2nd, 2017 work paper. Okay, and just on South Jersey Industries.
Judge, if I could void the ire for a moment,
Go ahead.
I may have an objection. As I look at this sheet on South Jersey Industries that is part of Spire's Exhibit 53, and I look at the lower right-hand corner for the date, my copy says June 2, 2017.
I can, yeah, these are,
Go
What
ahead.
does yours say, Dr. One?
So,
Does it say June 2, 2017? The lower right?
my version have December 2nd, 2000. Something is not correct.
I think you're looking at the wrong.
yeah, these are work papers, those aren't exhibits. We're referring to this work papers.
Yeah, aren't these the work papers?
No.
I think Mr. Thompson and myself were confused, because it was referred to as one of these exhibits, but
Yeah, but it's not, Your Honor, just so you know, it's not the work, it's the work papers, it's not the exhibits.
I'm following now. Go ahead.
So referring to the value line sheet for South Jersey Industries in the December 2016
December
value. Yes,
2016?
yes.
Okay,
South Jersey Industries.
yes,
And you compare that to the June 2nd, 2017 value line. So if you look at the projected dividends per share growth rate, you know,
yes,
okay. And on the December one, the projected dividend growth rate is 6.5%. And on the June 2nd, 2017 one, it is 4%, correct?
you're right.
So they've changed.
Yes, keep changing.
One more example, please look at SJW 13, which is your exhibit. And if you look at one gas, there on the December 2017 DCF estimate,
So do you mean my exhibit?
yeah, your exhibit SJW-13.
Okay. Yes,
So you get there and you look at that, and you have there for one gas under the December 17 DCF estimate, a 17% projected DPS growth rate of 17%. You see that?
yes,
Then when we look at the June 2nd, 2017 value line sheet, you have that in front of you. The value line sheet for June 2nd, 2017, and you look at one gas, and you look at the projected dividend per share, and that's 13.5%, isn't it?
right.
So let me ask you this, have you, in reviewing your exhibit number 13, SJW 13, are there corrections to that exhibit that need to be made to update those input numbers?
I don't think so, because I just using the value line numbers, and then I compared to the last case filed, and then this rate case proper time period, and then that is my best I can do in the direct testimony. And then authorized ROE is not simply calculated mathematical formula. Just this is estimation procedures. So I don't need to change anything in here.
Let's look at so if you look at, excuse me. So let's look at SJW 13.
Yes,
And the dividend per share numbers that you used there in that first column under the 2020 DCF estimate,
you mean the dividend per share?
yes.
Yes,
In column 1,
yes,
okay, they start with Atmos at 2.3,
yes,
right? And it goes to 1, then New Jersey Resources 1.27, right?
yes,
And if we look at value line dated February of 2021, that's exhibit number 54 in front of you.
yes, I have it.
And so everyone knows in the room, we're comparing SJW 13 exhibit and exhibit number 54 on the value lines of it. And that value line report
Yes,
is where you obtain those dividend per shares, correct?
right,
Okay. So if we look at that and we compare those to Exhibit 54, we start with, the first number. The first number there on your report shows Atmos Energy with a dividend per share of what number on your SJW 13?
2.3. Yes.
If we compare that to the value line report on the dividend per share, what's that number on exhibit number 54?
2020, 2.3.
No, this is February 26, 2021. That's
So what I'm saying is the column of dividend yield.
Column of the,
Column for dividend yield.
But I thought you just testified that you used the value line February 26, 2021, which is marked as exhibit 54.
Right.
For the,
Also, yes, this
Right.
document, yes,
for the
right.
data. So, and in your report, you have it at 2.3,
Yes.
right, on SJ 13, but in reality, when I look at exhibit 54, that number should be 2.5, correct?
2.5 is the 2021, and then as value line described it, all the figure are value line estimate. Step did not use estimate number.
But if we go back to, we talked about updating numbers and updating information, this $2.50 number should be the dividend per share in the February 26th, correct?
2.3? Yes.
So why are you using 2.3 and not 2.5?
2.3 is a historical proven number, and then 2.5 is in February, they estimate. So STEP did not use estimate dividend number.
For those on the WebEx and listening on the live stream, the counselors are conferring for just a moment. We'll return right to questioning.
So Dr. Wan,
Yes.
the 2.5 dividend per share number used in Exhibit 54, you saying that's projected or that's not already distributed?
So in here, what you gave to me, there is some explanation for the bold figures are value line estimates.
Dr. Wan, would you tell me where you saw that at?
So in the middle of,
Thank you, sir. I found it.
yes,
Right underneath the calendar entries for 2021 and 2022, top third of the page. Okay.
So these are not the dividends that have already been declared.
I'm not sure, just I rely on what value line described it.
But it's not the most relevant information.
I don't know.
let's move on to your, next issue, and that's the CAPM, inelastic pricing model.
Yes.
And I noticed that, you referenced SJW 14 there, and I draw your attention to that, is that correct?
Yes.
And I draw your reference to the betas used in, SJW 14.
Yes.
And those, that information in SJW 14 comes from value line reports?
No.
Wasn't, these aren't referenced to the February 2021 and June 17 value line reports?
So we didn't directly use print version of value line, but as I described in my staff report, we using the same methodology, value line D.
So looking at exhibit number 54,
Yes.
okay? Exhibit number 54 is the February 26, 2021 value line, is that correct?
Yes, right.
Okay. And if we look at the, first page of exhibit number 54, and we compare that to SJW 14, let's start with the first entry, which is Atmos Energy.
Yes.
Have that? Okay. And on Atmos Energy, you show a beta of 0.65 in SJ14. Do you see that?
Yes.
Okay. And if we looked at exhibit number 54, which you stated is the relevant February 26, 2021 value line report, the beta in the upper left corner for Atmos Energy is 0.8. Correct?
Yes.
And we can go down the list, to go to the next page, which is in exhibit number 54, which is New Jersey. And we look at the beta there, and that's 0.95
Yes.
versus what you had in exhibit SJW 14 is 0.93, correct?
Yes.
So there's a difference in those betas. And so on and so forth if we went down the line. If we did the same on SJW 14 and we look at the information provided in the 2017 CAPM estimate, there are betas in column 2 there too, correct?
Yes.
Okay. And now turn to exhibit number 52, which is the value line reports for the proxy companies dated December 2nd, 2016, correct? Exhibit number 52.
52 is your work papers, Dr. Wong?
We got a
So
different
I
one
have
for you.
53
No,
and
53,
54.
you're right, Dr. Wong.
53?
Yes,
Okay,
53.
53.
I'm sorry. It is dated June 2nd, 2017 for the record. And if we look at the betas there for Atmos Energy, at the top, you have it 0.69 and they have it at 0.70, correct?
Yes.
And we turn to the next page, New Jersey.
Judge, at this point, I'm going to object to relevance. Dr. Juan testified that he did not use betas from the value line reports.
Mr. Carroll?
Yeah, the relevance is we're gonna show that if you use that and you modify exhibit number 14, SJW number 14, it comes up with a different number for, the capital asset pricing model.
Can't you just ask him that?
Do you agree if you change those, you interchange those?
I agree.
Okay.
We're on 55, Judge.
So marked?
May I approach your witness?
Yes. Thank you, sir.
Thank you.
Dr. Juan, turning to what's been marked as exhibit number 56, would you look at that?
55.
Excuse me, 55.
Thank you, 55. Go ahead.
On the bottom of exhibit number 55, it has corrected schedule SJW 14, correct? Bottom right-hand corner.
I wouldn't say this is correct one, but the different version has this number, yes.
Right, right. And so if we were to interchange the betas from your SJW 14 and input the betas from the value line reports of 2020, February 2021, and the value line reports of June 2017, the corrected betas would be listed in column 2, correct?
I don't want to say that is a corrected version. It's different version have this number, yes.
So why,
Your Honor, I'm sorry, can I create some clarification on this? Is this something that Dr. Juan produced, or is this something the company has produced?
the company's producing it, and we're validating it, that these are the betas from those two value line reports which he relied on.
I didn't rely on value line reports for better.
I don't want to interject here again, but I just want to point out that the corrected schedule number is going to be confusing for the record. Can we change that?
Yes, Mr. Carroll, I would appreciate if we stop calling it the corrected numbers. It's been explained. Thank you.
Thank you. We'll note so.
Judge, we're willing to stipulate that if you use different inputs, you will get different results, which seems to be the point Mr. Carroll is trying to make.
Yes.
I'm taking your nod as an affirmation that you will agree to that stipulation.
I would agree to that stipulation.
Excellent. Do you have any more questions for the witness?
With that, I'd like to move to admit our exhibits. 52, 53, 54, 50, and 55.
I'd like to ask, Mr. Thompson, I'd like to ask Mr. Carroll, where did you obtain exhibit 55?
55 was created with the corrected betas.
Please stop calling it corrected.
Excuse me. 55 was created using betas from value lines.
I understand what the numbers are. Where did you get it?
We used Dr. Juan's work paper.
I didn't produce this document.
If you look at SJW.
No, sir. Can you just answer where did you get this piece of paper?
We modified it from,
That would have been good information to know.
we modified it from SJW 14 using Dr. Wan's exhibit.
Now that we're at the bottom of this mystery, we have a motion for 4 different exhibits. I will go one at a time. I'm sorry, Mr. Thompson, I have the wrong glasses on. Did you have something?
I have an objection to Exhibit 52 in that I've never seen it.
52 purports to be the work papers that Dr. Wan turned in, for lack of a better word.
I don't have 52.
I also thought the work papers were 53. Is that what other people had?
I have 53 and 54 and 55.
53 is the June 2nd, 2017 value line report.
That's what I have.
54 is the February 26, 2021 value line report. And Exhibit 55 is the different version of SJW 14 produced by the company.
Yes.
But staff objects to 52 because council has never seen it. This may be surprising, but attorneys do not typically look at work papers.
So you're saying you've never,
I've never seen it, I don't know what it says, I don't know what's there.
Wait,
I'm not worried about your verification though, Mr. Thompson. I'm worried about his.
actually,
It is customary to hand out copies of exhibits to
Did
the
he?
council.
Did we not get a copy of Exhibit 52? I know I didn't, but
We did not.
I don't have it.
Mr. Caro,
Oh, did we not? Okay, we may not have.
this seems like several errors with exhibits.
I'm looking at December, the exhibit that's been marked as 52 is the December 2nd, 2016 value line.
No, sir. 52 is the confidential, smart confidential, and it was described to me as work papers. It was described on the record as the work papers that Dr. Wan supplied to support some other testimony.
Then we'll withdraw 52. And move to admit 53, 54, and 55.
Okay. Exhibit 53, the June 2nd, 2017 value line stapled report. Any objections to the admission of that onto the hearing record?
No objection.
Hearing none, so admitted. Exhibit 54, the February 26th, 2021 version of value line, also stapled together, purporting to be the companies that were grouped together for this. Any objections to Exhibit 54?
No objection.
So admitted. Exhibit 55, which we will term the different schedule SJW-14. Does anyone have any objections to the admission of Exhibit 55, the different schedule SJW-14?
No objection.
I do object to the extent that it has the word corrected in schedule. I would like that struck and changed.
That bothers me too. How do we go about having that struck and changed and keep our finger on, we've all not objected?
What I would offer as the simplest solution is simply to have the company email out a different version with the name changed.
I see a nod.
Of business, and other parties can object if necessary.
We agree.
Excellent. We're all in agreement. We'll move forward. Mr. Carroll.
Yes, one, making sure that we admitted 51, which would have been the RRA report.
I'm sorry, say that again?
It's the, Regulatory Research Associates report.
Which number was this?
51.
51, thank you. And this is marked confidential?
Yes. Thought we have it, I'm just making.
I have it marked on mine. Let's just boot, or suspenders and belt. Any objections to the admission of confidential? Exhibit 51, hearing none, so admitted.
Thank you, no further questions, Dr. One, thank you. I
Thank you.
appreciate your patience and attention.
Mr. Gleiser.
Good morning.
Good morning.
We're very close to being good afternoon, but still the morning. I have some good news. I'm not going to cross you on ROE. But do have just a few questions, if you would indulge me. Can you turn to page 36 of your servo?
Yes.
At lines 11 through 12, would you agree with me that it reads, the corporate credit ratings assigned to Spire, Missouri by Moody's is A1, while Spire is rated Baa2. That is 2 notches lower.
Yes.
And just for clarity, by Spire, you meant Spire Inc., correct?
You're right.
Would you agree with me that the ratings you are discussing are not the corporate credit rating, but rather the rating for specific debt instruments?
That is more accurate description.
As I'm going to hand out 2 documents, I'm not going to have them marked, and I will explain myself in a minute.
Go ahead.
These documents are confidential, and I will check with counsel for just a moment.
Thank you.
Which ones did you get? Spire, Missouri, Spire Inc.
Sure. We've got April 2021, are the 2 of them?
There is April 1st, 2021 for both, one for Spire, Missouri, and one for Spire Inc.
We've got the Spire Inc. one.
Yes, I have Spire.
That's Spire, Missouri.
Oh, thank you.
Do you have a Spire Inc. for us? Thank you.
Sorry for that confusion. Really quick, Mr. Wan, reviewed some Moody's investor service reports that you relied on for that statement. Or similar to that.
Not, yeah, similar but not exact.
Would you agree with me that the type of rating, or rather the type of bond for Spire Inc. is a senior unsecured?
Yes.
And the type of bond for Spire Missouri Inc. is a first mortgage bond.
Yes,
Would you agree with me that a bond secured by a mortgage is probably going to be rated higher than an unsecured bond?
I agree with that.
All right, now, Your Honor, these documents have been already filed into EFIS in a different case. I would ask the commission to take administrative notice of them as they are filed into case GR-2021-0334.
Are there,
John, are they filed as confidential in that case?
They are filed as confidential in that case, and so I would assume they remain confidential.
No objection.
No objection.
hearing no objection, so admitted, so noticed. Thank you.
Thank you. Mr. Juan, could you turn to page 40 of your rebuttal? Actually, you don't even have to flip. Let me just straight ask. Would you agree with me that Spire Inc. has a vested interest in supporting the current equity levels of Spire, Missouri so as to drive rate making?
I don't.
Fair enough. Do you have a copy of what was previously entered into the record as OPC's Exhibit 235? And Judge, this is what I referenced earlier, so it will be a different page.
That's okay.
I'm going to hand you a copy.
Which page? What are you at?
Could you turn to page 12 for me? Should say considerations at the top. Now, in order to preserve confidentiality, I don't want you to read anything on this document. But if you could read the second dash under the third bullet point, if you follow me. Can you read that sentence to yourself?
Yes.
Does that change your answer to my previous question?
This is, I think this is Spire opinion. I do not know that is really true.
I do not know what.
I do not know that is really true or not.
Nevertheless, I would like to add page 12 to the original. I don't know, given the circumstances, whether that would need a separate offered and et cetera.
I am, just to keep things clear, I'm going to treat this as a separate exhibit. Mr. Kleiser, I have on my list here at 236.
This was my list.
It will be confidential. It is page 12. And just to restate for everyone, Mr. Kleiser has moved for the admission of all of this report, which I have taken under advisement. Thus, we are just going one page at a time. The Office of the Public Counsel has offered Exhibit 236, which is one page of data request 3036, specifically page 12, again marked as confidential.
No objection if treated consistently with 235 as confidential.
No objection.
Without objection, it is so admitted. Go ahead, Mr. Weiser.
Thank you. All right. Once again, can you turn to page 37 of your servo? Please let me know when you're there.
So, sorry, but
37 of servo.
Yes.
Would you agree with me that at lines 10 and 11, it reads, Spire Inc. has not been the primary source of long-term and short-term debt financing for Spire, Missouri, and this appears to continue to be the case.
I'm sorry, which line is that?
Lines 10 and 11 of page 37.
Thank you.
so that is my understanding.
Is Spire, Missouri receiving affiliate loans through Spire Inc. for short-term debt?
It would be, I'm not detailed check for that part.
Okay, I would like to mark another exhibit, which would be 237, I believe.
Yes.
Judge, given the other skinny versions, I did not print the entire 10K this time, which is several hundred pages. I just printed the one page.
Thank you.
I assume that's how you operate. All right. As I explained to the judge, not sure if it was on the record, this is not the full 10K, it's a skinny version as we have done in the past. But, Mr. Wan, would you agree with me that this is the, or at least the cover page of this is the 10K filed by Spire, Missouri, or, sorry, Spire Inc. with the SEC?
Yes,
And if you turn it over, you go to page 30 of the actual report. The second full paragraph under 29, you would agree that it reads, the utilities rely on short-term credit and long-term credit capital markets, as well as cash flows from operations to satisfy their seasonal cash requirements and fund their capital expenditures. Utilities access the commercial paper market through a program administered by the holding company, which then loans borrowed funds to the utilities. Utilities trip, out there. Agree that that's what it reads?
yes,
Would offer OPC 237.
Any objections?
No objection.
We would prefer to have the entire 10K because utilities isn't defined in those paragraphs there.
Sorry. I can try and add the page that defines it, or I'm okay with putting the whole 10K in. I was doing this because of the previous skinny version. leave it to the commission's discretion. I have no problem with that.
I think, Your Honor, I think if we can add the definitional section, that would address the issue.
We already have a couple outstanding, exhibits to follow up on. Let's make this one of those. Okay, let me find my paperwork. Okay, are there any objections to the admission of Exhibit 237, Section 1, 10K, which is currently 2 pages, and I expect it to be 3 or 4 pages, and if we can get that by,
I will try to make it by close of business, but if you can give me till Monday, just to be absolutely sure, but I'll make a concerted effort to be by close of business today.
we will go back and revisit all of these, but let's go with close of business Monday. I'd like to be more consistent, so I'll give everyone else that extra time. Are there any objections? Okay, we'll allow this in for the moment, subject to objection, written objection afterwards, and I'll set a time for that another time. Go ahead.
All right. On page 41 of your rebuttal testimony, I'm not sure you'll actually need to review it, because you're probably gonna know what I'm talking about. You identified 4 factors that support why you would continue using Fire Missouri standalone capital structure, right?
Yes.
All right. I know there's a disagreement between our office and staff regarding whether those 4 factors are met. For the purpose of this question, I'm going to assume that you continue to believe that those 4 factors are met. If you believe those 4 factors are met in the next rate case, and Spire comes back in seeking the same capital structure, would your recommendation be to maintain that same capital structure?
No.
What would you look for to determine when to recommend a different capital structure?
The
Beyond
one
these 4
of
factors?
main thing is, about the short-term debt. We need to check that is intentionally Spire Missouri manipulate or not. We need to check. Spire Missouri manipulate short-term debt better. I need to check that.
Thank you. No further cross.
We're going to take a pause here and go ahead and have lunch. I note that it is 12:05. I have questions for Dr. Wan, and not now, but that will trigger our recross. We also have one more witness, Mr. Murray, that we will have questions for. Let's go ahead and take lunch. I will look around the room for suggestions of a later time than 1 p.m.
I would push it to 1:30 or 2 personally.
1:30, 1:15,
Yeah, 1:15.
1:15 gives us
1:30.
1:30.
No change.
Spire only gets 1 vote, so it's 3-1. We'll come back at 11:30.
11:30.
I'm sorry,
That'd be a late night.
1:30 for lunch. That's 1:30 p.m. today. Thank you. We are recessed and off the record. Let's go on the record. Testing. Thank you, Kayla. Let's go on the record. We are back from our lunch break. We are finishing up issue 1, cost of capital. This is Spire's general rate case, GR-2021-0108. Just before we came back on the record, the parties have jointly moved to admit the remaining exhibits which have not yet been admitted for pre-filed testimony in this case. Have I adequately phrased that?
Yes, that is correct.
And we're going to go through these exhibits one at a time, but at a fair clip.
Yes.
Okay. We'll start with the company. I'll start my list at Exhibit 4. Do I hear a motion to admit the testimony of Scott Carter, direct testimony?
That's correct.
Any objections? So admitted. Next on my list is Exhibit 8, Ms. Dean.
Shaylin Dean.
Thank you. Exhibit 8 and 9, direct and rebuttal. Any objections? So admitted. Next is 13 and 14, Lou Keithley. Rebuttal and rebuttal. Do I hear a motion from Spot? I've already stated I had a joint motion for all of them. Any objections? None, so admitted. Next on my list is Spire's Exhibit 21 and 22, Tricia Lavin, direct and rebuttal. I'll take both of those together. Any objections? Hearing none, so admitted. 23 and 24, C. Eric Lobser, rebuttal and rebuttal. Any objections? Hearing none, so admitted. Next on my list is Exhibits 29 and 30, Alicia Mueller, direct and rebuttal. Any objections? Hearing none, so admitted. Next is Exhibit 31, Robert Nolker, rebuttal testimony. Any objections? Hearing none, so admitted. Next, Exhibit 37 and 38, we'll take them together. Julie Traxel, rebuttal and rebuttal. Any objections? Hearing none, so admitted. Staff's list is next. On my list, Exhibit 100, Karen Lyons, direct. Any objections? Hearing none, so admitted. Exhibit 102, this is one we have brought up before in discussion and testimony. This is staff accounting schedules. Any objection? Hearing none, so admitted. Next is Exhibit 5, Notice of Filing Corrected Class Cost of Service Testimony. This is the corrected direct of Robin Cleathermes. Exhibit 105, any objection? Oh, that's got a public and a confidential. That's got a public and a confidential version. Any objections? Hearing none, both are so admitted. Next is 106, Corey Boosted, rebuttal. Any objections? Hearing none, so admitted. 107, Exhibit 107, rebuttal testimony, Ann Crow. Any objections? Hearing none, so admitted. Exhibit 109, Claire Eubanks, rebuttal testimony. I'm sorry, I missed one. Exhibit 108, Saeed Dinderlu, rebuttal testimony, any objection? Hearing none, so admitted. Exhibit 109, rebuttal testimony, Claire Eubanks, any objection? Hearing none, so admitted. Exhibit 110, public and confidential rebuttal testimony of Jared Giaccone. I apologize for the pronunciation. Public and confidential, any objection? Hearing none, so admitted. Exhibit 111, rebuttal testimony, Nancy Harris. Any objection? Hearing none, so admitted. Exhibit 113, rebuttal testimony, public and confidential, Robin Cleathermes. No, any objection? Hearing none, so admitted. 114, rebuttal of Sarah Lange, public and confidential. Any objection? Hearing none, so admitted. Exhibit 116, rebuttal of Karen Lyons. Any objection? Hearing none, so admitted. 117, rebuttal of Keith Majors. Any objection? Hearing none, so admitted. 118, rebuttal testimony of Joel McNutt. Any objection? Hearing none, so admitted. Exhibit 120, rebuttal Keenan Patterson. Any objection? Hearing none, so admitted. Exhibit 121, public and confidential, rebuttal testimony, Charles Poston, P.E. Any objection? Hearing none, so admitted. Exhibit 122, rebuttal testimony, David Summerer. Any objection? Hearing none, so admitted. Exhibit 126, amended rebuttal testimony, Nancy Harris. Any objection? Hearing none, so admitted. Exhibit 127, surrebuttal, Kimberly Bolin. Any objection? Hearing none, so admitted. Exhibit 129, surrebuttal, Kim Cox. Any objection? Hearing none, so admitted. Exhibit 130, public and confidential, surrebuttal testimony, Jared Giaccone. Any objection? Hearing none, so admitted. Exhibit 132, surrebuttal of Robin Cleathermes. Any objection? Hearing none, so admitted. Exhibit 134, surrebuttal of Karen Lyons, public and confidential. Any objection? Hearing none, so admitted. Exhibit 137, public and confidential, surrebuttal testimony of Keenan Patterson, professional engineer. Any objection? Hearing none, so admitted. Moving to the Office of the Public Counsels.
The only unsubmitted should be Mr. David Murray, who's here to testify today.
I guess we'll wait for him.
Can you verify that he is the only pre-filed?
Yeah, yes, that's all that is missing on OPC's list. Anyone has a printout of the interveners list? I'm looking for mine currently. Their exhibit list. I have the Vicinity Energy Kansas City exhibit list. Exhibit 800, direct testimony of Greg Meyer. Any objections? Hearing none, so admitted. Exhibit 801, rebuttal of Greg Meyer. Any objections? Hearing none, so admitted. 802, rebuttal of Greg Meyer. Any objections? Hearing none, so admitted. We'll take the next three together. Exhibit 803, 804, and 805. This is direct rebuttal and rebuttal of Brian Collins. Any objection? Hearing none, all three are so admitted. Exhibit list of the Missouri School Boards Association. They have one exhibit. This list titles that, enumerates that exhibit as number one. They did. It was direct testimony, Louis Irvin. I don't remember from, I do have my procedural schedule up. I should stop talking on the mic. This is making a record. Hold on. I don't have a number assigned for them. Vicinity on their own initiative took 800. I will start with 900 for Missouri School Boards Association. This is Exhibit 900, direct testimony of Louis R. Irvin, second on behalf of the Missouri School Boards Association. Is there any objection? Hearing none, so admitted. I do understand he is listening online, and I am not waiting until last just because of that. I have Consumer Counsel's exhibit list.
Yes, Your Honor, we have one piece of testimony marked as Exhibit 700.
Excellent. Mr. Kaufman, would you like to move for adoption of that exhibit onto the hearing record?
Yes, thanks you. I'd like to offer the direct testimony of Jackie Hutchison into the record, Exhibit 700.
700 has been so offered. Any objections? Hearing none, so admitted. Thank you, Mr. Kaufman. I also have Mr. Bars for Legal Services of Eastern Missouri, their exhibit list. Exhibit 600, direct testimony of Jennifer Hegeman. Any objection? Hearing none, so admitted onto the hearing record. That's exhibit number 600. That is all of the exhibit lists that I have. Do any of the parties know of any others? Thank you.
Yes, National Housing Trust has exhibit number 400, the direct testimony of Roger Colton, and 401, the rebuttal testimony of Annika Brindle. I think the parties have moved for joint admission of those exhibits.
Anna who?
Annika, Brindle.
Thank you.
You've heard the motion. Any objections? Hearing none, so admitted. Exhibits 400 and exhibit 401. And Kayla, if you could check on any other testimony that we have not already admitted, and just email me if we need to cover any others. Let's move on. Oh, we have another.
I brought this up on Monday, Judge, but did you want to enter into, the record as an exhibit, the joint stipulation that was filed on July 23rd? We have another on July 30th, and then one yesterday, August 5th.
Yes, let's. I am going to enter them as Spire's exhibits. I see no head shakes to that. You're at 56 by my list.
Yes.
So 56, 57, and 58 for the three. Would you please tell me the dates of those again?
July 23rd, the school board exhibit, well, school board said,
Mm-hmm.
July 30th, and August 5th.
Thank you. You have heard the motion to admit exhibits 56, 57, and 58, which are the July 23rd non-unanimous partial stipulation and agreement, the July 30th non-unanimous partial stipulation and agreement, and the August 5th non-unanimous stipulation and agreement. Any objections? Hearing none, so admitted. And we will now turn to our witness. Thank you for your patience. Dr. Wan of staff is testifying, and we had taken our lunch break just after direct and cross-examination. Again, I note we have all five commissioners participating in this hearing, and if they are on a phone, it is *6 to unmute. And I will open it up now for any commissioner questions for Dr. Wan. Our issue we're having today, or issue we're discussing with today, is issue number 1, the cost of capital. Hearing no questions from the commissioners, the judge does have a couple questions. From a capital structure development perspective, what is the recommendation for how short-term debt is treated?
Staff's position for short-term debt, it should be exceed short-term asset and CWIP short-term debt.
In your expertise, when should short-term debt be included in the capital structure?
So compare current asset plus CWIP portion.
I'm sorry. Start again.
Current asset plus CWIP is bigger than short-term debt. There is a debt portion of amount that should be included capital structure.
When QUIP and short-term asset debt exceed the short-term
debt.
okay. when those two exceed the short-term debt, then that's the triggering event.
That portion should be included capital structure.
Okay, thank you. Why?
So that is a kind of matching principle. The purpose of short-term debt should be cover short-term expense and assets. But if that is exceed a portion of that, so actually that's served for capital. So that should be included in capital structure.
I think I heard you testify this morning that you'll be looking at that, the staff will be looking at that in the future.
Right.
Why not in this case?
In this case, we have no evidence there is a manipulation of short-term debt level.
Okay. I asked our earlier witnesses about some legislative changes. Are you familiar with the change to the gas ISRIS statute?
No idea.
Do you know of any rule against a company targeting its capital structure? And what I mean by that is making sure that the debt to equity ratio remains relatively constant. Is there any problem with that?
That fact itself does not problem.
Okay. How did I'm going to switch back now to construction work in progress. How did the average level of QIP and other short-term assets compare to the average short-term debt since the last rate case?
So in this proceeding, staff look at true level of short-term debt and other current assets and CWIP. That is May 31, 2021. That is consistent with last commission decision. So that is a comparison right now.
That's all the questions I have. That opens us for recross. Give me a second while I shift gears. Spires witness.
Thank you, no questions.
Mr. Gleiser?
Thank you. Just the one. You had a quick back and forth with the judge, and I want to make sure that this is clear on the record. So I'm going to attempt to state your position, and you can tell me if I got this right. When it comes to the inclusion of short-term debt should be included in the capital structure if the amount of debt exceeds short-term assets. Is that accurate?
Mr. Kleiser, it's in addition to QUIP.
It is your position that short-term debt should be included in the capital structure if the amount of debt exceeds short-term assets plus construction work in progress, also known as QUIP, correct?
Exceeding portion, yes.
Yes. All right. Thank you. Just want to make sure that was clear.
Thank you.
No further questions.
And redirect, Mr. Thompson.
Thank you. Well, we've covered a lot of ground. In response to some questions from Mr. Caro for Spire about the average level of ROE in 2021, did you testify that it is trending down?
In second quarter of 2021, it goes down.
Thank you. And with respect to your schedule SJW 13, there was a lot of talk about information on value line reports. Do you recall that?
Yes,
And that information was different from what appeared in your work papers and that you used in your testimony. Isn't that right? There were some numbers that were different than the ones you used. And I think you testified that nonetheless, no change was necessary. Is that right?
right.
And did you say that staff did not use any estimated numbers?
Estimate number for dividend,
For dividends?
yes.
And did staff use value line reports betas?
No,
I think you testified that staff calculated its own betas using the value line methodology.
yes.
There was talk about, and this is referring to Exhibit 237, which was a skinny version of the 10K of Spire Inc. Do you recall that exhibit?
Yes,
And Mr. Kleiser pointed you to some language that indicated that the parent accessed the commercial paper market and then loaned short-term funds to the operating utilities. Do you recall that?
yes.
Now, assuming that that is true, so what?
It's very regular relationship between parents and subsidiary.
Would that change any of your conclusions?
No,
That's all the questions I have, Your Honor. Thank you.
Thank you, Dr. Wand. You are dismissed from the stand. Appreciate you being here. Mr. Murray, as you come up, I'll make an announcement for our streaming and WebEx, and also our live audience, here in the courtroom. This is our last witness not only of today, but of this case. So, I don't think that we're within 5 minutes, but I do want, council and their assistants to start thinking of any, announcements and/or, discussion items for the end of the hearing before we adjourn. Mr. Murray, please raise your right hand. Do you solemnly swear or affirm that the testimony you give in this hearing will be the truth?
I do.
Thank you. Please have a seat, state and spell your name for our court reporter.
Thank you. My name is David Murray, last name is spelled M-U-R-R-A-Y.
Mr. Kleiser, your witness.
Thank you, Your Honor. Mr. Murray, by whom are you employed and in what capacity?
Employed by the Missouri Office of Public Counsel as a utility regulatory manager.
Did you prepare or cause to be prepared direct rebuttal and surrebuttal testimony for this case?
Yes, I did.
And do you have any corrections to make to your testimony?
Yes.
And did you file or cause to be filed a errata sheet outlining what some of those changes are?
Yes.
Notwithstanding that, did you also have corrections to your schedules?
Yes.
Notwithstanding those corrections, do you have any other corrections?
I do.
What would those be?
Please be patient with me. Not a lot, but things that need to be clarified. Page 37, line 13, excuse me, page 37 of my direct testimony, line 13, it indicates LDC as compared. There should be an insertion of industry in between LDC and as.
Mr. Murray, Mr. Murray, do you have, more than 3 corrections right now that you're gonna tell us about?
It may be more than 3, I mean, it might be around 5.
What, do the parties think about just an errata sheet?
I would prefer that.
Okay.
Your Honor, I was anticipating offering the currently filed errata sheet as 218. I was also, based off conversations from previous days, going to offer the updated schedules as 238, which is, as I understand it, my next number. Very good. I would offer, I guess, the OPC can supply an errata sheet at 239 to address the corrections that Mr. Murray was going to make on the stand. That is agreeable.
It is, and that brings us to my first reminder for the end of the hearing. Let's talk about the due dates for the various exhibits and their associated objections. Okay, let's go ahead with Mr. Murray.
With these corrections, if I were to ask you the same questions that were posed to you in testimony, would your answer today be the same?
Yes.
I'm going to go ahead and offer 215P, direct testimony of David Murray Public, 215C, direct testimony of David Murray Confidential, 216 PNC, the rebuttal testimony of David Murray, both public and confidential, 217 PNC, the surrebuttal testimony of Mr. Murray, both public and confidential, 218 David Murray errata sheet, 238, which will be be the corrected schedules of David Murray, and 239, which I'll say is the second Murray errata sheet. Although that document has yet to be produced, I will provide a copy at least by close of business Monday, unless the court orders otherwise.
Mr. Kleiser, the 238 correction to the schedule, is that, what was emailed today or yesterday?
It was emailed out last night, and I emailed all schedules as a single file. I was hoping to avoid having to enter a bunch of different exhibits.
That is acceptable to me. I'll look to the parties to see if anyone has raised eyebrows or is pulling their hair out. Nope, sounds awesome. And the witness is tendered.
I offered them.
Oh, I'm sorry. I got ahead of myself. You have heard the motion of Mr. Kleiser. Exhibits 215, public and confidential, 216, public and confidential, 217, public and confidential. All of those, the various testimonies of Mr. David Murray, and 218, David Murray errata sheet. Also 238, which is correction to schedules, which was emailed, and 239, which is yet to be filed, and those are just an errata of the various other corrections. Any objections?
No objection.
Hearing none, so admitted.
And I tender the witness for cross.
Thank you, and that goes to staff, Mr. Thompson.
Thank you. Looking at page 19 of your rebuttal, you stated that Mr. DeSentis' DCF supported COE estimate is based on irrational assumptions. What were those irrational assumptions, if you know?
You refer me to line number.
Oh, I was afraid you were gonna do that. Bear with me a minute, Judge.
I think I found it. It's on line 3 on page 19.
I think that's correct. Yeah, I think the pagination of the printed ones is different from the ones online.
Well, I mean, I'll kind of jump in 1 second. We did file the corrected rebuttal versions with pagination added as per the commission's request. Those are what I had intended to offer. And
Using the same exhibit number. Go ahead.
Thank you. I think I go on to explain some of my concerns about the irrational assumptions. Obviously, with South Jersey Industry, he used he assumed that the dividends of South Jersey Industries can grow in perpetuity at a 10.44% compound annual growth rate on a year-over-year basis forever into the future, and that's very irrational. That's higher than the return on the S&P 500 over the long term. And then just a fundamental difference of opinion, or difference of opinion that is not supported by any of the investment analysts' valuation that I've reviewed and analyzed over my career of equity research, that dividends are never compounded in perpetuity at the 5-year earnings per share compounding and growth rate, the consensus equity analyst compounding and growth rate. So that's irrational in and of itself.
And would you agree with Dr. Wan's testimony that the company's experts' ROE recommendation is simply too high?
Yes.
And looking at page 21, and I'm looking at lines 1 through 4. You testified, did you not, that you've never observed a DCF analysis that assumes a company's cash flows will grow in perpetuity at the same rate as equity analysts' consensus 5-year CAGR and EPS. Is that correct?
That is correct. Let me clarify that, and that's true for an investment analysis, an equity investor's, determination of a fair utility stock price. Obviously, in the rate of return area of utility rate making, things are done a little bit differently, which are not a reflection of reality.
And turning to page 23, I'm looking at lines 1 through 4. You testified that Mr. DeCendis' risk premium estimates are unreasonable. Isn't that correct?
Yes,
Okay. Why do you believe they're unreasonable?
they're far outside of any consensus of risk premiums used by Spire Incorporated itself for purposes of its own internal valuation analysis. It's far outside of anything used by utility investors.
Would you agree that using those unreasonably high risk premiums would result in unreasonably high results?
Yes.
And looking at page 24, I see there's some confidential information that I'm going to stay away from. Looking at lines 1 through 3, I believe you testified that the market risk premium used by Mr. DeCendis is almost double your market risk premium.
Yes, that's my testimony.
Do you consider that market risk premium to be reasonable or unreasonable? The one that Mr. DeCendis used. I'm sorry.
Mine's reasonable. This is unreasonable.
We think yours is fine. And again, with the use of that market risk premium, would the result of the calculation be unreasonable?
Yes, it's a direct input.
Going to page 26. And I'm looking at lines 23 to 26. You testified that you doubt the reliability of Mr. DeCendis' risk premium estimates. Is that correct?
I'm sorry, I do not see that. What page in line number?
I'm at 26, line 23. The question is, what is the primary aspect of Mr. DeCendis' risk premium estimates that causes you the most concern about their reliability? Answer, the mere fact that he estimates a very wide range of results and gives each result equal weight in his final equity risk premium estimate. So am I correct in understanding that your testimony is that this estimation method used by Mr. DeCendis is unreliable?
Well, what I'm saying is he has, I think I specified, there's 18 different risk premium estimates in Mr. DeCendis' cost of capital analysis, and I think some may have been a little more reasonable, maybe about 7% or still higher than mine, but some may go as high as, I mean, I have to look at this one, but 11, 12% might be close to the range of where some of his high ends are, and he gives them all equal weight. I just don't think that is taking into consideration what's going on with the equity markets, with consistently breaking all-time high valuation levels recently.
So as a result, would you consider the results of his calculations using those numbers to be unreliable?
Yes.
And what about his use of a non-regulated proxy group? Is it your professional opinion that that is an appropriate analysis to use in determining the COE or ROE of a regulated utility?
It's just impossible to find an industry, that has the same risk profile as monopolies.
It's a worthwhile endeavor, but it just doesn't, the characteristics are just too different. I mean, you could have really high growth companies, not dividend yield investing companies. The risk differentials are just too disparate, in my opinion.
So is it your opinion that the results obtained using that non-regulated proxy group should be discarded?
Yes.
And with respect to the adjustments Mr. DeSantis made, is it your opinion that the flotation cost adjustment is improper?
That's definitely very improper. I have taken a specific issue, flotation cost adjustment.
In fact, those are flotation costs incurred by Spire Inc., isn't that right?
Yes, this totally contradicts their position not to adopt a consolidated capital structure. They asked for recovery of Spire Incorporated's security issuances, which includes common equity since 2013-14. And in their testimony, they indicate, and I say they, Mr. DeSantis and Mr. Woodard, that these Spire Incorporated security issuances, including the common stock and the preferred stock, and even now the equity units, do benefit Spire Missouri. And so that's a direct contradiction of their initial opinion that Spire Missouri is an independent company. So, but the point being to that is these common equity issuances, especially the ones in 2013 and 14, those were issued to make acquisitions of Missouri Gas Energy and Alagasco, and there was a specific stipulation and agreement that the commission approved through order when it approved those transactions. That transaction cost shall not be recovered from ratepayers and security issuances to fund the acquisition of those transactions are definitely a transaction cost. So yes, I take very specific issue with the flotation cost request. Even at that, those have been recovered if it can be shown to benefit Spire Missouri plant. The historical approach for that is to have it have the tangible expenses recovered through some type of asset amortization and not as adjustment to ROE.
Thank you. And finally, do you agree with Mr. DeSantis' small size adjustment?
I do not.
Thank you, Mr. Murray. No further questions?
And Mr. Carroll?
Thank you. Good afternoon, Mr. Murray.
Good afternoon, Mr. Carroll.
Your recommendation in this case is for a 9.25 ROE, is that correct?
That is correct.
You testified in the Empire District Electric case in 2019, is that correct?
That's correct.
And your initial recommended ROE in that case was 9.25, correct?
It was.
You testified in the Missouri American Water case that concluded earlier this year, is that correct?
Excuse me. Yes, that's correct.
And your recommended ROE in that case was 9.25%, correct?
That is correct.
And that case number is WR-2020-0344, is that correct?
I don't remember specific, but that sounds, why would I dispute that?
You also testified in the earlier Missouri American Water Company case in 2015, correct?
As with staff, I did, yes.
And your recommended ROE in that case was 9.25%, correct?
I don't recall.
hand you, if there's no objections, I'm gonna hand you, copies of. Strike that, what I just said, on there. We don't have that testimony from us. You testified on behalf of the commission staff in the 2017 Spire rate case, is that correct?
That's correct.
Those case numbers were GR-2017 -0215 and 0216. Would you accept that subject to check?
I accept that without subject to check.
And your recommended ROE in that case was 9.25.
9 to 9.5 with a, midpoint of 9.25, correct?
And your recommended ROE again in this case is 9.25, correct?
Recommendation of 8.5 to 9.5, and I chose to recommend the 9.25.
Based on that, information, we'd like to ask that the commission take administrative notice of his testimony in those two cases, the WR-2020-0344 case with American Water and the ER-2019-0374 case involving Empire.
For the purpose of establishing that Mr. Murray recommended 9.25,
Yes.
he just testified to that.
Okay. Regarding your question involving flotation costs, did the commission properly allow them in Spire's last rate case?
The commission allowed them. I don't agree it was proper.
Thank you. I have no further questions.
Thank you. We'll turn to our commissioner questions. Are there any commissioner questions for Mr. Murray? I don't hear any. The judge does have a few questions. Are you familiar with the legislative change to the gas ISRIS statute?
I am.
And you heard my my question to some of the other witnesses today?
Yes.
Did you include do you believe that that statute will increase the number of projects or replacements that Spire can recover through its ISRIS?
Can you repeat that question, please?
Do you think the change to the law will increase the number of projects or replacements that Spire can recover through its ISRIS?
Yes, there won't be any challenge. I mean, OPC had challenged the past, before the law was changed, and so, that kind of gives a fairly smooth glide path for the company, because it got the law changed to refute, the disallowances that had happened in those past cases. So yes, they'll be plugging along with, continuing to make, ISRIS investments and maybe even on an accelerated basis.
I am not an economist, so I apologize for my phrasing of this question. Did you use the change in statute, the gas ISRISs, as an input into any of your calculations for the setting of the rate in this rate case?
It was not a specific consideration. Evaluation of the business risk, financial risk, changes in the regulatory legislative environment, just thinking about capital structure and debt capacity. When those types of things occur, that reduces business risk, so that would be, to me, that's another reason to question a static capital structure. So, but just mindful of these things, and as to supporting the ability to issue or have a higher debt capacity, more leverage in its capital structure.
So I'm hearing you say that you did consider it in the overall.
In general sense.
Okay.
Yes.
That is it for my gas interest question. Let's get back to the capital structure. Your testimony addressed that fairly specifically. Can you explain to me and for the record, simple terms, what is the problem of a company targeting or trying to keep its debt, equity to debt ratio fairly constant?
Same, static. Well, I think, I think what happened in this case is proof of what the problem is. I mean, I'll venture to say that I think the commission, when it authorized the 54.2% equity ratio in the 2017 case, that it didn't believe that it was setting, what the company should use going forward. I don't know if there's anything in the record on that, but I don't think that was the intention of the commission. But the commission knows what its intention was there. But anyway, the point being is that you definitely expect, and it does happen at the Spire Incorporated level, for a company to adjust its capitalization policies based on changes in the capital markets, whether it's common equity valuation levels, changes in debt cost, lower business risk, issues going on with affiliates, which is very much an issue with Spire Incorporated, and trying to keep the cost of capital low.
I don't mean to cut you off, but my question is, can you tell me what the risks are? They admitted it. He testified that, yes, we are trying to manage that. Can you tell me why that's wrong?
I'm sorry, can you clarify? They testified they were going to manage the Spire, Missouri capital structure or Spire Incorporated capital structure?
Spire, Missouri. This is a Spire, Missouri rate case.
I know.
Okay.
They're managing it to a static capital structure, and yes, that's wrong.
Why?
Because it doesn't take into consideration the fact that the cost of equity for Spire, which provides, as the company indicates itself, that the equity issuances benefit Spire, Missouri. So in 2020, LDC stocks were out of favor. They were declining at lower price to earnings ratios. Spire Incorporated had intended to issue more traditional common equity, but they recognized that the costs were higher, so they got more creative. But so with Spire, Missouri, which is set for rate making purposes, which we've verified, it's just a matter of, let's plow ahead with the highest equity ratio because that's what's going to be put into rates. They're not focusing on it for purposes of managing the financial risk, the credit metrics of Spire, Missouri, to achieve the most efficient capital structure, which would allow for a lower cost of capital situation.
Can you identify any damage to ratepayers?
Yes, they're being charged too much, over $20 million a year.
Can you give me some citations?
It's in my testimony.
You're testifying about someone's intent, the purpose. I'm failing to see how that damages ratepayers, and I'm failing to see I haven't heard anyone plainly explain why their managing of that ratio is bad for business or bad for the ratepayer or is bad business practice in general. I understand that you see these applications come in and numbers are going to be varied. We're a company, we're borrowing money, we're spending money, and we see that our bank has a lower rate, we're going to go take advantage of that. So I can understand that a company that comes in with almost exactly the same capital structure ratio would be a red flag. I want to take it to the next level now. Can you explain to me what the red flag is? I get that you're saying that they purposely are doing it. Well, let's just assume that's true. Why is it bad for ratepayers?
One thing I'm having a hard time doing is I know that there are exhibits that are confidential that, support OPC's position, as far as how Spire Incorporated is managed and why it considers a triple B plus, credit rating to be consistent with the efficient frontier. And the efficient frontier is a financial term that means.
I'm familiar with the testimony.
Yeah. So, so what's good for the goose is good for the gander, correct? I mean, as far as.
Not talking about Spire Inc. Spire, Missouri.
Spire.
How about we take a hypothetical? There's a hypothetical utility in Missouri called Squire. And Squire keeps its capital, what's it called? Equity to debt ratio constant. Exactly the scenario you have laid out. No holding company is involved. What is Squire doing wrong?
If there's no holding company involved, then they get the benefit of having a higher equity capital structure, which means their credit rating is not impacted by the holding company. So, point being is, if it were a standalone entity, then the higher credit rating that would be assigned absent its affiliation with no holding company should result in lower debt costs. It will still be a potentially cost-efficient capital structure, but at least the ratepayers that are paying for that equity-rich capital structure will receive the benefit of that financial stability of it being a standalone company that's not associated or affiliated with non-regulated entities and higher leverage by companies that manage it.
Is that's it? That's the disadvantage?
Yes. Yeah, it's affected by its affiliates, yes.
Okay. Is there any rule against a company doing that, targeting its capital structure to keep it consistent?
I'd say it's a
Unusual.
rate-making principle, but is there a rule? I mean, as far as a legal rule, I mean, I don't know of any legal rule.
A legal business practice rule?
I would not think that, the business practice, that's not normal.
I didn't ask if it was normal. They might be the smartest people in the room. I'm asking if they're breaking the rules.
I would not invest in them.
Not what I asked.
They're not running the company efficiently. And if that's their rule.
Tell me how.
They're maintaining an equity-rich capital structure that results in a higher cost of capital for its investors, which reduces their shareholder value.
It results in a higher cost of capital because they have a holding company, and that's just how they got structured. Is that correct? That's why
That's
the,
how Spire structured them, yes.
okay.
Spire Incorporated structured them, correct.
So is your complaint that the creation of the holding company should be undone or shouldn't have been done in the first place?
Can I point you to a couple examples of Atmos and One Gas?
Please.
They're not a holding company, organizational structure. So when they go to their commission and they have 55 to 60% equity, in their capital structure, that's real equity. That they actually went to the public, third-party shareholders, so that equity supports the equity invested in the assets that are held at the parent company. And the parent company is not a holding company. And so, they themselves, and that's in my testimony, that that is transparent to the regulators. It's not trying to shift debt capacity, which is my opinion, to the holding company away from the regulated utility, which is the lowest risk asset in the group of companies.
Okay. Do you know what percentage of Spire Inc.'s consolidated structure is allocated to non-regulated businesses? Sorry, I should have announced that I'm going to switch gears.
I mean, I know that, say, for instance, Spire Storage, has a much lower equity or much lower capital, asset value now, because it had taken a write down in 2020 of $140 million. As far as what the capital mix, I mean, based on the Spire consolidated capital structure where all the debt is at the holding company, that certainly implies that the debt is supporting the non-regulated, which defies the relationship of business risk with financial risk, which is not putting the financial risk on the non-regulated riskier enterprise that can't support it. And that's why Spire Incorporated has to provide parental guarantees to those non-regulated entities.
Okay. And in your testimony, you indicated that Spire, Missouri has not issued any dividends to Spire Inc. in the last few years.
I said it's been intermittent.
Okay. Are those dividends reinvested in Spire, Missouri?
What?
I mean, I guess the ones that
retained cash, retained earnings is reinvested in Spire, Missouri.
Okay. How does that impact the capital structure?
It gives the appearance of an equity-rich capital structure. Again, a confidential exhibit, the company clearly communicates that if it weren't for its LDCs, the low-risk businesses, they could not maintain the consistent dividend that they're able to pay to their shareholders, which they do by issuing additional capital at the holding company to make up for those deficiencies, which is only possible because of the better credit quality of the low-risk subsidiaries.
Do you have Schedule DM-D-9-3 of your direct?
I do, and I'm looking it up, sorry.
That's okay.
Yes.
That shows Spire, Missouri's capital structure, excluding short-term debt, had an increasing equity from 54.59% in 2017 to 59.15% in 2019. Is there any benefit to Spire, Missouri having a higher equity in the capital structure than was approved in the last rate case?
No.
I'm going to switch gears again. Your SIR rebuttal testimony, page 13 to 14.
Yes.
You indicate that Spire, Missouri has, on average, since the last rate case, maintained at least 11% short-term debt in its capital structure, of which, after deducting the quit balance, CWIP, from the short-term debt, the remaining short-term debt made up about 7% of the capital structure. Now, in your schedule DM-D-10-1, you outline a quit-adjusted capital structure for Spire, Missouri. Equity at 52.79%, long-term debt at 39.93%, and short-term debt at 7.28%. Could you please explain how you arrive at the 7% short-term debt for the capital structure?
The 7.28% is based on the proportion of short-term debt in excess of QUIP, held at Spire, Missouri, shown on the Spire, Missouri balance sheet. Actually, I think I asked for Spire Incorporated QUIP balances to compare net loan ever received a response to that DR. So, but this is the proportion for Spire, Missouri's, short-term debt in excess of QUIP.
What value did you use for quit in that calculation?
I don't know if these are it's probably in my underlying work papers, and so I don't remember, the specific figures. I will direct you to, Mr. Woodard's rebuttal testimony for that purpose. He has a Schedule 2 attached, which, does a pretty good job of breaking out, the construction work in progress and what's generally referred to as deferred gas costs, which is the short-term assets folks were talking about earlier.
Okay.
So that's his schedule spells it out pretty clearly.
Okay, thank you. If the commission does not accept OPC's proposed capital structure, do you have any recommendations for an appropriate capital structure outside of staff and the company's proposal?
At a bare minimum, STL is a new pipeline, and obviously folks are aware of the issues there. And that there's risk to whether or not it even continues. It was a brand new pipeline, and they were authorized a higher rate of return as part of getting their certificate. FERC gave them a 50-50 capital structure, 50% equity, 50% debt. A brand new pipeline versus a company that's been in existence since the late 1800s and has fairly predictable ongoing investments for the foreseeable future with infrastructure replacement. I don't understand how anybody can with a straight face say that Spire, Missouri should have a equity ratio that's higher than what's assigned to the FERC STL pipeline. And that being said, I'm also aware, and this might be confidential.
Well, I'm not real sure how to proceed.
I'm just gonna say I'm aware there's other capitalization policies that apply to their non-regulated that are more reasonable than what they're asking for the regulated utility.
Okay. Thank you. I'm going to sum up that last answer as it should at least be 50-50, like the STL pipeline, and there are other examples within the Spire Inc. affiliate organization that you could cite. Okay.
Yes, and when I say 50-50, obviously the 50% of debt, my position, OPC's position is that 50% of debt should
Next topic on my list.
Yeah.
Which does take us to short-term debt. I was being serious. From a capital structure development perspective, what is the recommendation for how short-term debt is treated? This is the same question I had asked earlier. From a capital structure development perspective.
Well, if you don't mind, I'll explain what I, did in 2017. I didn't do the same thing in this case, but in 2017, I recognize that Spire, Missouri, has a fairly predictable rate case cycle in between their ISRS, ISRS surcharges, because they have to come back in order to be eligible for ISRS surcharges after 3 years, or 3 or 4 years. Anyway, point being is I wanted to evaluate the typical amount of short-term debt carried by the company during the period that the rates are in effect. And I think that's in my opinion, in my not understanding, that's the goal of rate making, is to represent the expenses, the revenues, the capitalization over the period of time the rates are in effect. And there is, my schedules show that, they carry at least 10% short-term debt consistently for 3-year periods, all the way, and as far as specifically in this case, from September 20th, 2019 until the May 20th, 2021. So yes, a third of a month should not be the determination of what is going to be expected going forward while rates are in effect.
And you just touched on something I just want to clarify from my edification. You said it's a consistent 10% of short-term debt. Mr. Woodard testified earlier that these are very short-term. It's a constant turnover. That doesn't explain away your theory. Your theory is whether it's a constant or whether it's one piece of short-term debt that lasts for X amount of time. It's short-term debt.
Yeah, I understand, the notion, and I think some people try to get short-term debt eliminated by saying it's a bridge. Well, if the amount of the QIP is a bridge, anything above that, that's being constantly maintained. If with gas companies, and gas companies are definitely a different animal, and so I disagree with comparing them completely to electric utilities. But they have the heating season, and that used to be the logic for assigning short-term debt cost to gas inventories. That occurred through the PGA-ACA process, and that occurred from 2002 till the 2017 rate case. And I can confidently and tell you that during that period of time, the carrying charges on stored gas was based on what's supposed to be a short-term debt rate. It wasn't the commercial paper rate. And so that's about $100 million or $100 million balance that typically had been in their rate base. And so before that, the company actually had recommended short-term debt be included in the capital structure before these inventories got moved over into the PGA-ACA. And I think the reason why that was done in 2002 is because gas prices skyrocketed. We had $2 gas, and then it went up to $8, $9. It was all over the place. But I think the company also said short-term debt costs can change considerably. And so I think they felt like this may be a way to capture both. But point being is this is not a foreign concept. It's definitely something that used to be the company's logic and position as well.
What level triggers short-term debt being included into capital structure?
Once the short-term debt exceeds QIP and these deferred gas costs, then yeah, you have to, do you think it's material? I mean, I think that anything, I've included short-term debt, and the commission has included short-term debt when it ordered the capital structure for Missouri Gas Energy, now Spire West in the Southern Union case in 2009. They put short-term debt in the capital structure of 2-3%, somewhere around there. And actually, that wasn't my recommendation. My recommendation was based on hypothetical, but that was somebody else's recommendation. But anyway, you know, if it's consistently and materially being carried, it's not up and down over, say, from, cycle to cycle, and it hits a threshold of 2 to 3%. Especially with extremely low costs we have right now. I mean, 0.2 to 0.3% is a pretty good margin if you can get a long-term rate of return assigned to those assets. So I think you have to take that into consideration as well.
It sounded like you have agreed with Dr. Wong that the cost for short-term assets and QUIP and whatever is excess of that should go into short-term debt. And the second answer that Dr. Wong had, I asked him, why not this rate case? And he said they're going to look at it in the future. Is that correct? Is it ready to be looked at now?
Oh, it definitely needs to be looked at now. They did the same thing in this, company did the same thing in this case that they did in the 2017 case. I disagree with it then, I disagree with it now. What they do is they issue long-term debt right in time for that end of the true-up period. So in this case, May 20th, 2021. In the 2017 case, they issued the long-term debt. I believe the true-up was September 30th, 2017, issued the long-term debt, and then pretended like that long-term debt reduced the short-term debt going back 19, 20 months. That is inappropriate. That is not, it's fictitious. It does not reflect how they are supporting their investments. It is improper, it's manipulation right now.
So you're saying that this rate case is the second example and 2 is too many?
1 was too many, in my opinion.
Okay, thank you very much. What amount of short-term debt did Spire, Missouri have immediately prior to the conversion on May 21st, 2021? We've heard about that change from some short-term to long-term.
Be patient, man, I have something in the schedule.
No, take your time.
My direct, I have September 30, 2020, which was the end of the test year, and that was 10.64%. Let me take a look at Mr. Woodard's schedule. He provides it all the way through as of December 31st, 2020, short-term debt. This is an average for the previous 13 months of each of the schedules. It was $393,675,000. He doesn't have it broken down in percentages.
Okay, that's all right. I thought you might have different numbers. Do you actually, while you have that there, Do you know the amount of short-term debt that was converted?
305 million.
Oh, well,
It was a net of 250, because the 55 million was used to refinance, long-term debt. 250 million was used to refinance short-term debt.
Okay. Let's talk dividends. In your testimony, you discussed Spire, Missouri's dividend payment history. I want to, just for the record, lay out the dividend payment process specific to this situation. Who owns common stock in Spire, Missouri?
Spire Inc.
Who does Spire, Missouri pay dividends to?
Spire Inc.
And that is Spire Inc., the holding company.
Yes.
Does Spire Inc. receive dividends from its other subsidiaries?
Yes. It does not depend on the non-regulated entities to fund the dividends that are paid to, ultimately to the shareholders, because it's just not as consistent cash flow.
What does Spire Inc. do with the dividends?
Well, it's to some extent, it's supporting the dividends that it pays ultimately to the shareholders of Spire Inc., own Spire Inc.'s common stock. I mean, this is where Mr. Woodard, as far as the treasury, I mean, once the money goes into the treasury, they're constantly, and there is a consolidated commercial paper program that Spire Inc. issues the commercial paper. So once that commercial paper comes into the treasury, I mean, it's hard to say for sure, what, if that dividend that's paid by Spire, Missouri, or Spire, Alabama, or Spire Gold to Spire Inc. is going directly to the Spire Incorporated shareholders. They just target a dividend payment, and the payout ratio is about 60%, and it stays that at Spire Inc. And so if they don't have the cash flows because of timing, then they'll just issue commercial paper to fund the dividend payment, because the utility investors depend on consistent and hopefully growing dividends, or else the company's going to have a hard time tracking capital.
And Spire Inc. is a 100% owner, correct?
Yes.
So it receives 100% of those dividends?
Yes.
Okay. Do you have a copy of Spire's annual financial statement for the period ending September 30th, 2020?
I do not have one in front of me, no.
I'm going to read it for you. I'm reading on page 11. As a holding company, Spire depends on its operating subsidiaries to meet its financial obligations. Spire is a holding company with no significant assets other than the stock of its operating subsidiaries and cash investments. Spire and Spire, Missouri, prior to the holding company's formation in 2000, has paid common stock dividends continuously since 1946. Spire's ability to pay dividends to its shareholders is dependent on the ability of its subsidiaries to generate sufficient net income and cash flows to pay upstream dividends and make loans or loan repayments. In addition, because it is a holding company and a substantial portion of its assets are represented by its holdings in the utilities, the risks faced by the utilities as described below under all caps, risks that relate to the gas utility segment, may also adversely affect Spire's cash flows, liquidity, financial condition, and results of operations. My question, what does that statement mean about how funds flow between Spire Inc. and its subsidiaries?
I mean, the only way to distribute funds to Spire Inc. is through dividends from its subsidiaries.
Okay, so the same situation we were just discussing.
The only other way would be through a loan.
Okay.
Well, yeah, you have to have a legitimate transaction, so that, it'd be dividends upstream from their subsidiaries.
Okay.
Judge, I don't mean to interrupt your flow, I'm sorry. What was that you were reading from?
This is Spire's annual financial statement for the period ending September 30th, 2020, page 11.
Would that be the 10K? Oh, never mind.
Thank you for letting me off the hook. Mr. Murray, I have no further questions.
Thank you.
You're not excused. I'm sorry. This does get us to recross. However, Mr. Murray is our last witness. It is 3 o'clock. It is normally time for our break. I would prefer to push forward unless somebody needs to take a break. Let's take a break. We'll call it 10 minutes, 3:10. Let's come back. We're at recess, off the record. Let's go back on the record. We are in the midst of our last witness on the last day of testimony in Spire's general rate case, GR-2021-0108. We have just concluded questions from the regulatory law judge to witness Murray. That triggers re-cross-examination. First, we will go to Mr. Thompson.
No questions. Thank you, Judge.
Thank you. Next, we go to the company.
Thank you, Judge, no questions.
Redirect, Mr. Kleiser.
Thank you, Judge. All right. There are several things I would like to discuss with you, but first, let's start with the questions from the bench regarding the impact of having that high equity ratio on customers. Do you recall getting those questions from the bench?
Yes.
I feel like we need to break things down on the most basic level. What is the impact of having a high equity ratio on customer rates?
They're higher. It's a higher revenue requirement, assuming you're using the same ROE, but it's just higher revenue requirement. Plus you have a tax gross up factor on equity, which makes it even more magnified.
So how does that factor into your concern regarding maintaining the existing Spire equity to debt ratio?
Based on my analysis of Spire Missouri's credit metrics, which produce healthy cash flows consistent with apparently higher than economical credit rating, which they don't receive credit for, that customers are paying at least $20 million, and with true up, it's going to be even higher. But in let's just say in the $20 to $25 million range, higher rates per year to achieve credit metrics that they don't get credit for from specifically Standard & Poor's.
Let's break down that 20 mil real quick, because won't decreasing the equity ratio increase debt, make it more expensive, make things worse?
No, all you have to do is the holding company has to quit using the debt capacity that it is afforded from its subsidiaries. So you can offset the subsidiary increase in debt capacity, or the debt capacity that it rightfully should be able to use, and reduce the holding company debt, which, like we've talked about, its only assets are its ownership in its subsidiaries.
So moving to your proposed equity to debt ratio will benefit customers without harming the company?
Yes.
All right, there was quite a bit of discussion about short-term debt. Do you recall the judge asking you how you came up with your 7% number?
Yes.
You had mentioned Schedule 2 of Mr. Woodard's direct, I believe?
Yes.
Just for the sake of clarification, can you walk us through the math on, say, the first month in that schedule, so we understand what you're talking about?
Yes, for September 2019, actually the deferred gas costs, including propane, is actually a negative value, which indicates that QIP is going to be reduced by the. Let me just add it up here real quick. So the QIP balance is $96 million, because there are deferred gas liabilities of negative $25 million, which are supposed to be credited. The customers are supposed to be provided consideration for the fact that the company has the customer's you need to offset the quit by $6 million. So that means that there's only a short-term asset balance of $91 million in September of 2019. And so that shows up in his final calculation there. But the biggest problem is all he should be doing is taking that $386 million of short-term debt outstanding minus that $90 million to determine the net short-term debt balance for that month is $296 million. But the company pretends like $250 million of long-term debt that's issued just in May was issued 20 months ago. And so they make a pro forma adjustment. So that's not reality. That's not how, I mean, it's not there. Pro forma adjustments are usually going forward. They call this a pro forma adjustment. I call this a rewriting of history.
So did I hear you say something in the effect of there's $91 million in short-term assets plus quip, and how much, 300, 400 million of short-term debt?
$386 million of short-term debt.
And you're saying the company is erring because it's doing what exactly?
It's rewriting history and pretending like it has $250 million of long-term debt that to refinance the short-term debt in September 2019 based on a long-term debt that's issued 20 months later.
Judge asked you several questions about dividends. Do you recall that?
Yes.
In particular, I believe he asked you, what does Spire Inc. do with its dividends? And you talked about paying them out to customers, or sorry, shareholders. Let me get my parlance correct. Is there anything else that Spire does with the money it receives from its utilities?
Well, that's what provides it all the credit support. That's what allows it to provide parental guarantees to its, mainly to Spire Marketing, which it's increased considerably over the last year when we had the spike in gas prices. Obviously the counterparties want a financially sound entity to deal with, and the LDCs support that credit quality that Spire Incorporated has. And so even if the dividends aren't distributed to the Spire Incorporated because they're reinvesting the proceeds back to Spire, Missouri with ISRSs, they have a lot of, they're assured of recovery, especially with the legislative change. And so the business risk has dropped considerably, and that's what provides the credit strength of the holding company.
I'm neither an economist nor an accountant or any of those fancy things. So for my, education, a parental guarantee is what exactly, and how does that work into this?
The parent Spire Incorporated, so if Spire Marketing is a counterparty to purchasing, gas to try to transport to another customer, the vendor that's working with Spire Marketing realizes that Spire Marketing doesn't have as sound a credit quality as Spire Incorporated, which is supported by the utility. So it wants the Spire Incorporated to backstop and be able to follow through on that commitment and honor Spire Marketing's obligation.
And Spire's using the money it gets from the utilities to do this.
It's using the low business risk, the value of the assets, because like I said, it's not just a matter of money, cash flow, it's a matter of the risk profile.
Can you elaborate?
Yeah, because Judge Hatcher asked about the dividend payments, that there are quarters where Spire Missouri is retaining its earnings. Well, it's retaining its earnings because, they are accelerating their ISRS spend. And from a internal financial management standpoint, yes, it makes no sense to go ahead and pay the dividend up and then have the capital contributed right back down into Spire Missouri. Just leave it there, but it's still part of one consolidated enterprise. And if it wasn't for not just Spire Missouri, I keep it honest about Spire Missouri, Spire Alabama and Spire Gold, they make all this possible as far as this, you know, the sound credit, position from the parent level.
You were asked a question by the judge, what would happen if the commission didn't accept Spire's or your proposed capital structure? And, you mentioned other capitalization policies, and I think, do you recall that?
I think he was wondering if there's anything else that, could be considered to be a consideration, other than the recommendations that are before the commission.
Do you recall telling him that there were other capitalization policies at Spire Inc. that could be used?
Yes.
Where would those be cited?
In the board of director materials.
And that's the confidential material that you're alluding to?
Yes.
Going back to the cross that you received from company, you were asked about a recommendation in the Empire Electric Company case. Do you recall that?
Yes.
What was the outcome of that case with regard to the specific recommendation you made?
Commission awarded on a 9.25% and a capital structure of 46% equity, 54% long-term debt. Again, electric utility, so different circumstances as far as short-term debt, but also a situation where there was a leverage used at the holding company.
The company also asked you about a Missouri American Water case. Do you recall that?
Yes.
Where you again recommended 9.25.
Yes.
What was the outcome of that case?
That case settled.
What was ordered with regard to the capital structure in that case as part of the settlement?
There was no capital structure identified in that settlement.
Oh, you're saying it's black box?
Yes.
Okay. You were asked a cross question by counsel for staff regarding flotation costs, and you indicated that you believe that they contradicted the argument raised by Spire Inc. regarding its capital structure. Do you recall that?
Yes.
Are there other factors that contradict the capital structure argument?
Just obviously the actively managed Spire Incorporated capital structure that I've discussed in my testimony, and the static commission directed 54.2% that apparently is if it continues, is going to be the ongoing capital structure. So, but the point being is that the fact that the company has come back and contradicted themselves in this is Mr. Ascendis and Mr. Woodard, that these holding company security issuances benefit Spire Missouri, and therefore the flotation costs should be paid by Spire Missouri customers. That is entirely inconsistent with saying that Spire Missouri is an independent company.
Thank you. I have no further redirect.
Thank you, Mr. Kleiser. Before the witness is excused, and I do not want to ask the witness any more questions, I want to ask Mr. Kleiser, but this may involve the witness, so I want to keep him. In your opening statement, you mentioned a study or analysis that OPC has performed comparing the monthly or quarterly short-term debt to short-term assets.
I'm going to defer that back to you, actually.
It's in the opening statement.
In Mr. Kleiser's opening statement,
I think what I was referring to is the fact that the testimony that Mr. Murray put forward, that it's been approximately 7% of their short-term debt was supporting rate base, i.e. was not supporting the liquid balance. Or I was referring to Mr. Woodard's analysis in his direct.
Okay.
Sort of, I apologize.
Thank you, we've got it. You're excused.
Thank you.
For those listening on the live stream and on the WebEx and in the hearing room, we are within 5 minutes of closing this evidentiary hearing altogether. This is the last day of testimony. Let us turn to some announcements or issues. I have a handful of exhibits that we have discussed. I'm looking at council, that we were going to, by we, I mean you, are going to submit at a later date. And we had discussed a couple of dates. Is Monday the 10th currently the latest date that I have assigned? I'm looking at the attorneys that are likely going to be doing that, putting together.
Your Honor,
August 10th.
the 10th is Tuesday, and I believe that that is the day we discussed.
Tuesday works for me. All parties have until Tuesday to submit the exhibits that we previously discussed as being outstanding. If Tuesday is the 10th, is that Friday the 13th? Friday the 13th, objections to aforementioned late filed exhibits will be due.
Your Honor, you had mentioned with regard to the exhibits presented and offered and accepted by parties that you wanted those sent directly to you. I believe you had mentioned something about within the 10 business days that we expect to turn around the transcript. I don't know if you had a ruling on exactly when we should be doing that.
Yeah, let's set a date. Well, what Mr. Kleiser and I are discussing is with some of our COVID precautions, the commission has altered the way it receives commission exhibits to put into the record on EFIS. So for the past however many months, and we will continue for this hearing, the regulatory law judge will take the responsibility of submitting those. How that works is I don't need them until I get the official transcript turned in. That takes 10 business days. That's where the 10 business days comes in. That's what I base my calendar on. So we're at the 13th is 1 week from today. So the 20th should be 2 Fridays. So the 20th, I'm seeing head nods. What was the due date for?
Offered and accepted exhibits from parties.
Yes, to send to the judge. Send all of your exhibits, send me all of your exhibits. And I will just forward those with the transcript, making sure that they are marked with the appropriate exhibit number.
Not to add more confusion then, does the judge want us to send copies of the pre-filed testimony, or will you still be taking those from, okay.
The errata sheets I don't have. And I'm getting more comfortable with this emailing on procedural issues, so I will touch base by email with counsel. I'm going on vacation, so it'll be late next week. As to if I'm missing any. What I don't want to do is I do not want, I'm responsible for the record. So I want to make sure that whatever exhibits we've all agreed to make it in. Anything else? It's been a long week. I'm a little scatterbrained, which is not out of the norm.
Does the current schedule include briefing? I apologize, I haven't looked at it. Are we standing on that briefing schedule?
Until I hear otherwise, and I brought up the schedule, just in case I got asked, right now, initial briefs, September 7th. Reply briefs, September 17th. November 11th is our operation of law date. Operation of law date means the decision has to be out, or the commission has to reject the tariffs, or they go into effect by operation of law. So that is the date we are all aiming for. Any other questions, announcements, issues? Yes, sir.
There's also a true-up evidentiary hearing currently scheduled for Monday, the 23rd. I was going to suggest that the council will work together and advise the RLJ whether or not that's going to be necessary.
That's an excellent suggestion. Anything else? The evidence you're hearing for the Spire General Rate Case, caption GR-2021-0108, is adjourned and off the record. Finally adjourned.